nothing. Okay, that's pretty cool. Clean, easy morning. When the market opens, I got that. And then last thing I do is Commitment Traders. We'll talk about that really quick. Commitment Traders is one of the best things that you will ever learn if you didn't know anything about futures. In about 5 minutes, I'm going to blow your mind on how you can use this to predict market reversals. You guys ready? I'll give you the cheat sheet for this. I taught this class to so many people. Now other influencers and teachers are teaching this class to people. I brought this importance up in a couple of really big podcasts I was on, and other people that were like, you know, I've known about the Commitment Traders and I mostly overlook it until you said something about it, Matt. And then now there are people that are like, hey, I teach your Commitment Traders to my people. Is that okay? I don't want to plagiarize you. I'm like, please teach it. I want everybody to teach this thing that I came up with. So a lot of people out there now teach my COT class, which I'm about to teach you a couple things of it, which is lovely. I love it. Okay, so a little bit about my background. If you guys are checking out here, I'm a futures trader. I've been trading since 2010. I've been trading live on YouTube since 2016. I've been full-time since about 2015. I'm the CEO of the Rocket Scooter trading platform. I built this trading platform you see on my screen. I also invented all these techniques. I'm a pioneer in the gamma exposure field of study in markets. So this is where we're kind of like in that camp. All the stuff that we do at Rocket Scooter is based on gamma exposure models. A lot of it is. It's predicting volume using options. Where'd I get this awesome pivot from that I drew yesterday at 5 p.m.? Solely based on options data. It's neat. And I'm trading futures off of this options data. My chemical engineering degree is on the floor over there. Graduated third in my class. I used to teach fluid dynamics at University of Houston. And now I am trading for your entertainment here on YouTube. So futures trading is something that is really fun, especially if you get really good at it. It's always a challenge and always a puzzle, but we want, you know, traders to be equipped to face it every single day. You don't have to be an engineer, a mathematician, or a genius to make something for yourself in the world of futures. Trading, you just have to have a couple of things correct in your mental game and a lot of preparedness to know what you're faced against. A lot of you guys learn trading and you learn basically like, well, I'll just buy here and make some money, or I'll short here and make some money. But in reality, trading has a lot more to it. You're going to have to figure out a whole lot of stuff. Risk management is really the key to making money in this game. Position management specifically. Risk management is more like where you cut your trade or where you cut your loss, but position management is how big you bet, and how you bet is a big deal, right? Because I know the volatility is a certain way, right? I'm going to, for instance, if I think my pivots are going to be sharp, I have a way to know if we're going to be sharp on that pivot or bounce around there. If I understand the two different dynamics of markets we have, I'm going to enter differently. If it's going to be choppy, I'm going to spread my bet around the pivot, right? If it's not going to be super choppy, I'm going to enter in like right at the pivot. So there's the different types of markets allow me to enter and play the game differently. That's just one thing I'm telling you to let you know that you're going to say to yourself, oh man, okay, he does a lot that I don't do. Because the people that do well in this game do a lot that you don't do. And there's a lot because you just never considered it. Because the people that you learned from or that taught you were actually really good at this to begin with. I'll tell you, as far as like YouTube goes, or as far as trading goes in the social space, I personally have never seen a trader on YouTube that's impressed me. They're good, they're decent, they're average, above average, they're okay. But I've come across one person in my entire career doing this that was at a pace to where I told myself I want to learn from them. Like they have something to teach me. And that's different for me because I'm pretty far ahead in the game than a lot of people. So it's going to be hard for me to find a master or something in YouTube space that really gives me that desire to learn something. But for you guys, I think a lot of the people out there are like much further ahead from me. So you can learn something from everybody. But for myself, I find it hard to find somebody to learn from because a lot of the people that I've seen that teach things don't really teach trading. Like right here, a little bit of weird volatility here. I'm deciding if I like this pivot or not. Hopefully we're good though. They don't really teach trading. And what a lot of people that teach out there is just chart reading and technical analysis, which is basically just like how to read a chart. Trading is not how to read a chart. It's not what time frame you use. It's not what shape you draw on your chart. There are people that have entire trading algorithms that they sell that have nothing to do with trading. They're just picking a place and buying and picking a place and selling. And honestly is nothing more than just reading charts. And that's not a trading education. And the difference is, and I tell people, and I'll tell you this, commitment traders, is going to completely blow your mind in a second, is that like what mostly you learn in trading education out there is people are going to give you a chart, a bunch of time frames, a bunch of pictures, and tell you act right here. It's the same thing as you learning poker and somebody say, just wait for the royal flush. Trust me, when you get the royal flush, you're going to win. Here's the cards. Okay, all you need is a jack. Okay, cool. Where's the jack? 5-minute chart. Where's the queen? If you're waiting for the cards to come, that's not playing poker. If you're looking at the chart, that's not trading. If you're picking places off the chart to trade, that's not trading. Poker is the art of betting around the odds delivered to you. The probability of getting the card you want. What's the odds of winning with the cards you have? You can see cards other people have. You can see cards a dealer has. There's a certain amount of cards left in the deck. What are the odds? Okay, if your odds are high, you're going to bet bigger. If your odds are not high, you're going to bet smaller. That portion of what I just said is what trading is. It's the art of betting correctly with the odds you're given. And the stock market is just like poker. Each card is random. Each interaction between people is random. Stock market is 100% unpredictable. As the famous hedge fund manager Jim Simon said, the stock market is an amalgamation of nothing more than Brownian motion of individual participants all acting in their own self-interest. Long-winded answer is saying the stock market is random. It's not coordinated. There's no army of people taking out your stops, evil big bad market makers, none of that. Everybody is acting completely in their own self-interest with little to no coordination between the big players out there. Everybody's looking to make money off of everyone else. So there's no like magic force pushing markets in a way. Oh, the market makers took my stops. There's a whole army of people out there that teach this nonsense, candlestick trader mentors that teach stop sweeps and like there's some magic hidden in the candles. So this is by far the most nonsensical thing to an engineer. To have to come out there and see that the majority of trading education is teaching you goofy stuff. There is no secret society of liquidity providers that know your stop is there to try to take it from you. As a matter of fact, just to kind of move on from this topic, your stop loss is not even known on the order book. Not even your broker knows that it's there. A stop loss is instructional just in your platform. And all it does is that when a stop is triggered, your platform fires a market order and then your broker and the market is aware of it. Nobody knows your stop is anywhere. It's unseen. It's hidden. It's not even your broker that you're trading through knows your stop is there. They're not watching your platform. All that stuff is local on your computer. So you said Larry Williams was the first person you heard about talk about the commitment traders. Aha. Okay, so let me tell you. Let me show you guys something really cool. Let me show you how awesome the commitment traders is, but let me show you the results first before I show you the trick. Commitment traders is mentioned by people, but things I'm going to tell you about it. Okay. So hang tight. I'm going to show you a tweet. I always love to bring this up to show people what you can do with it. Okay. All right. Can I convince you that I've used it to call major market reversals with high degree of accuracy? I'm talking like on the longer scale of the market. Okay. My favorite little chart to bring up when I teach this class. Okay. How's my trade doing? Oh, I'm green now. We retraced. I took some extra risk at the dip. I just wanted to hold 2, so I did my cost basis management. I averaged in right there at the bottom. Now I'm going to trim. So you guys are watching a little cost basis management here. I longed just to get in on some kind of a trade with a small amount. I wanted to have maybe 2 or 3 contracts total. We fell to my pivot. I longed a couple more and got a little harder on that trade. I got hard, giggity. And now once it retraced the distance from this impact line, I just trimmed down to 2. Now I'm in the green with my cost basis here. I longed there, but somehow here I'm still green. This is part of trading. It's managing. I got the initial trade wrong, but I still played off of my stronger pivot with the heavier spot. I did want to be in 2 contracts total, so I used 3 to dig out of that. If it falls here again, I'll jump in on another one. It falls there, I'll close out again. What I'm doing is I'm wiggling my cost basis lower, and that's one of the tricks I'm going to teach you guys today. So now I'm green on the trade when I was down $1,000 earlier. There's tricks to this. Okay. My risk management is underrated. Oh, I've got the best risk management in the YouTube game, baby. I don't win trading contests by picking the market, right? Stock market's random. You can see major flows in the market. You can see major directions of the market, but day to day, the market's random. Technical analysis won't get you anywhere. Risk management is what I do. Position management, that kind of stuff, is all that it takes. And that's where the real meat and potatoes is in successful trading. By the way, everybody, if you don't mind, do me a favor. Bottom left, wait, hold on. Bottom right of your screen down here, you can click a button. Thumbs up, give us some love. I'm going to show you something and tell you a story about the stock market. See, back in the day after COVID happened, right? The market suddenly turned around and rallied. And then, of course, during the rally, people were a little worried, right? Because we shut down the market back in, let me actually make this so it's easier for you to see it. And let me make sure I keep my trade in my purview here. I don't lose the vision of that. Make this big enough so you guys can see this. Let's hold this. Okay, so, you know, in the wintertime is when the flu happens, and people were worried that in the wintertime, the flu was going to happen again, right? At this time, Trump was president. At this time, Biden was president, right? Trump, Biden. And so when the Democrats were kind of pressing for us to shut everything down, people were worried. Now, again, this isn't political. This is just from a trader's perspective only. People were worried back here that COVID round 2 was about to happen. The market was getting a little choppy. We came all the way back to here, and everybody was like, you know what? If it got shut down when you know, Trump was the one in charge before through here, it's certainly going to get shut down when Biden's in charge, because the Democrats were the ones that were like, wear your mask, shut it down. So the stock market got a little wobbly. If you guys remember trading during COVID, it was like everyone was talking about here, are we going to have COVID round 2? Is there going to be another crash? And the market was weird for a couple of months because of that mentality. But it's stabilized and things started working kind of okay. And then right here, let me put this candle right in the way here. And so I use the commitment of traders as part of this analysis. And what I did was I tweeted that the bull market's going to double, actually. When people are saying it's going to crash and things are going to be bad again, I was like, no, it's going to double. This was at S&P like 3,000. And I said it's going to double in about 3 to 4 years. Yeah, this is like 3,600. And I said it's going to be S&P 6,000 in about 4 years in 2021. I'll tell you how I come up with these things, and I'm going to teach you guys this trick. There is no pullback or recession. And this is when people were saying we're going to have a recession due to COVID. There's always the bears come out of the woodwork, telling you the market's going to die or whatever. But no signs that it was going to be that way. Committed traders told me the answer. I said we're going to double the next 3 to 4 years. And people thought I was goofy. And I said that at all-time highs. And sure enough, in 2024, we were at 6,000. So I was right on that. And the market kept rallying from that call out. Now, it was crazy because through all the chop and nonsense, you can go to all my tweets for the last 2 years in that period, was I never was bearish at all until this one day. This one red day did it. And I said, futures opening suggests much more downside. This is the first time as long as I can remember that I'm seeing a possible short-term correction, which is a 10% change in the market. Volatility is going to take over this month and likely this quarter, and the sideline's a good idea starting now. And boy, did I call the fucking top there. January 5th, 2022 is when I made the tweet. Now, let me tell you how I did that. Again, the commitment of traders was one half of that equation. This candle did it. Not these waves, not this wave, not this wave. Just 2 charts. Positional data tells you these things. You can see it not in the candles, but you can see it in other things. Down here at the bottom, same thing that day, said we're going to rally for 2 months. So this is a combination of one of our tools called the monthly maps and committed with traders. I said, here's to a 2-month bear market rally potential. And we rallied for exactly 2 months, believe it or not, literally from July and August. And then we sell here, and exactly this spot is when I said I'm calling a bottom for 2022. And this was a funny story. Again, commitment traders. This was a funny story too, because I was on a podcast with some of the biggest fundamental influencers there are on Twitter, and we were all in a space together. And there was thousands of people watching that thing. And everybody there, it was like, you know, Jay Special Sit and Markets and Mayhem, and Peter Tuchman stopped by. There was a lot of people there, and everybody on that podcast was like, this is the bear market, man. This could be the collapse. COVID killed the economy, and now inflation, now stagflation, it's gonna die. And everyone was so bearish, and I was the only bull, literally here at the bottom. I was the only bull in the podcast, and some of these funny guys were getting a little irate because I was talking about the coming bull market, and they made fun, and they poked, but I was right. They're like, but Matt, but inflation, but Matt, and I'm positional data, guys. Positions don't lie. People are building to be bullish right here. And like, yeah, but they're trading this many times over earnings, and the stock market flew way after COVID. This is an overshoot. We went from 3,000 high all the way up to 5,000. The market's going to sell off and pull back. And I'm like, yeah, but positional data. I'm calling a bottom for 2022 and a rally through January from October. So I'm calling like 6 months of rally. And it doesn't even get nasty again until possibly the summer. So from October until the summer, that's it. And the market never looked back. Other than the Fitch downgrade we had, we rallied straight to 6. On literally this candle right here, a day after the reversal, commitment of traders as well, called the bottom. Is the music too much? Let me turn it down. Sorry, my bad. Okay. I can't even hear it, so. All right. You give up, you're leaving. Wait. I'm not even reading you on chat, my bad. Is that better? You good? All right. Okay, anyways. So here, I used 2 specific tools. And this is a very cool trick I want you guys to know. Now, the committed traders, I'll just give you a link. I use the bar chart version. I'll just turn it down. I can even hear it. Okay, so this is the version I use from bar chart, but they're all, you can use any one. CME has an interactive one. There's a lot of them out there. Just double checking my trade. Okay, we're good. It's just interesting. I don't like that it's not picking up momentum here, but the stock market's closed, which is very odd to see like this kind of behavior. Not really sure what to think about this. Okay, so this is a couple of really neat things I want you guys to do. Now, in our Discord, I will give you a handout. If you guys all join our Discord really quick, it's free. Go here really quick. I will post our handout for this for you guys all to take with you. There's going to be an ask for help channel when you get there. I'll just drop it in there. How about that? And you guys can have this little cheat sheet to go with you. And I'm going to teach you some trading tricks too. This is just an icebreaker. Trust me. This is the fun one. This is straight from our courses. And our entire course series is literally $1 a class. It's $1 to come in one of these classes. And this one's free. So we like to teach mostly for free-ish as much as we can. All right, so I'm gonna drop this in here. You guys can have this free little thing to take with you. It's President's Day. There's really, the stock market's closed, right? Y'all be nice to the person that was saying that the music was too loud. Hey, turn the music down. Okay, so what is the Committed Traders Report? Well, it's a very cool, interesting thing that you didn't know existed. Now, I'll tell you for a fact that positional data is all that I use to trade with. I calculate from options from positional data in S&P and NASDAQ ETF options to find futures pivots. How this blue line on my chart, where I long from today, 22,197. You may not know this, but I have a bot that puts that number in my Discord every single night. Here is your 22,197 is literally this number right here, high NQ. A bot calculates this high volume pivot from options. As we approach it, there's high volume, and it's a hedging thing. Positional data is everything in what we do. As you found out, the stock market and the movement of the stock market's unpredictable. It's random. but volume is not. Volume is 100% predictable. And this is the new paradigm of what we're teaching in trading, is that volume prediction is something that's repeatable and predictable. And it's something that you should add to your diet no matter what you're doing. Now, I stream for free every day. So this ain't a sales pitch. You guys can just chill into YouTube and hang out with us every day. But positional data is very important because people are not going to, positional data is going to reveal what people want to do and what people are doing and inside information. Imagine inside information about a company, and I decided to go make a bet on it. The best thing you can understand about the stock market is that there's no such thing as non-transparency. That bet will be known at some point, maybe sometime after a delay, but it's illegal to go make side bets on the stock market. I mean, you can't trade in a bucket shop. So if anybody has inside information about a company, they're going to go out there and buy something somewhere in that company. And the company's price is going to reflect the inside information. There's no way that information is hidden from you as a trader. It's buried in the positional data. Positional data will explain to you someone's intent. Now, an order on the level 2, if somebody want to buy or sell, it could be a bluff. Like, I want to buy and maybe draw the bid to my bid. Oh, I removed it. Haha, I spoofed the market. But you didn't put any risk on the table. You just feigned risk. You pretended to bet and then you head faked. But if you're in a position, you took the risk. Nobody's going to buy something and be like, oh, I'm selling it. Just kidding. I bought it, but I was tricking you guys. No, you only buy something for one reason, and one reason only, because you believe it's going to go up in value. Nobody buys without the intent to believe that they're stating their bullish position, okay? Does Bookmap show the volume or the intent of traders? It does not. It shows the volume as it's happening. Bookmap and other aggregators like this are good for one thing only, to alert you that something is happening, when it's happening, and where. It's going to be like real-time order flow analysis. It lacks the ability to be future predicting. Like, Bookmap is great for what it is. It's missing a piece. But Bookmap won't tell you, here's the level where volume will be. It'll just tell you when you get there, here's the volume and where it accumulated, right? So it's missing a key component. Being able to plan with it. I start trading Terra every day at 8:30, so I get here an hour for market opens. So if you want the missing piece, we're the missing piece. You put the two together, is dynamite. Here's the volume, right? The volume, you guys see the volume spike? The stock market's even closed, and I got a high volume pivot sitting here. Does everybody see this pivot off this blue line that my bot drew in the Discord print last night at 5 o'clock in the afternoon? How did I know there's going to be volume here? How did I know to buy there? This is solely based on options data, believe it or not. And I'm trading NASDAQ futures right now. You can see my trade on the top right of the screen while we're sitting here. I'm making a trade just to entertain you guys. So with that being said, positional data is so key to understanding where you can predict volume. You see the stock market's closed and I'm even predicting some volume here. Okay. How and why? And it's really important to understand that positions don't lie. And that's like the key to our training, is that positions don't lie. I've taught this same boot camp here to like global symposiums. I was at the International Society for Charting Technicians. What's the name? I don't want to get it wrong. It was like the European version of the CMT that we have here. I actually spoke at a symposium for these guys to teach volume prediction techniques and positional analysis. And they're all chartists. And they were like, the guy was like, we want something unusual here. And you're like the anti-chartist. And after I taught the class, I literally blew everybody's minds. They were like, oh my gosh, I'd love to learn more about this. This is crazy. And I'd love to add this to my charts. Because people realize charting data is just trying to find price action. But predicting volume is a whole different layer to the game. And you weren't able to do this 10 years ago because data feeds weren't available. And platforms didn't have the ability to give you this information. But like, it takes tech pioneers like us to take this new data that became available in the last decade and really create something special for traders. And volume prediction is really cool because you can say traders will be here because options tell me that. And it's a whole neat analysis, but it's a similar thing as the commitment of traders. With the commitment of traders is like a push of transparency that the CFTC did in the early 2000s. And the CFTC is the governing body of commodities trading. It's commodities, the government commission for commodities trading, which your S&P and NASDAQ futures like fall into that category, right? So somebody says, is it illegal to draw people into the bid and then cancel it right before? Yeah, like spoofing is not legal. You can get fined. It's not illegal, but you get fined. It's against the rules of the exchange. And so you can get fined for doing it and banned from trading if you do it bad. And it's technically like illegal in that social sense. It's not criminally illegal, but it's illegal in the trading world to spoof. Yeah, even if you put a bid of one contract and then you move it when it comes down, you put a bid up, you're also breaking the rules. Now, it's almost like, your one contract isn't a big deal, but anybody that bluffs the market and then removes their bet is breaking the rules of the market. So yes, spoofing is not allowed. And they make a case out of people that do it with like large amounts, like spoofing illiquid grains and meats markets and things like that by drawing the bid. And what it does is it really affects the global price of trade. And it's a bad thing for people to go out there and spoof like the grains market on certain weird abstract contract structured trades, to go out there and physically change the price of the commodity. That disrupts business and trade globally, and they don't stand for that kind of stuff. Imagine somebody tricking the stock market or tricking the wheat market to trade it 5% lower like 6 months out, spoofing a contract and stuff, and it really can hurt some big businesses, so yeah, spoofing completely not legal. Okay, so Committed Traders is a positional day. A CFTC in the early 2000s started telling any of these big positions out there, or big institutions out there, you must report your futures holdings to us. How many NASDAQ contracts are you holding? Are you long or are you short? And then people report their positions, and once a week, they take that data and they release it to us in the form of a report called the Committed Traders. Now, back in the day, the Committed Traders report was actually like a thing that was built for like the physical trading. Like if you actually trade the wheat or trade the oil itself, you kind of wanted to know how the positions were spread out. Like in this chart right here, there's a blue, a green, and a red line. And these are the blue, green, and red. Commercials, small speculators. This is not the one you're going to use. So when people teach this, and I think that Larry Williams was teaching this, this is an absolute useless report to you. Trust me. Don't use this one. They came out with another one in 2006 called the TFF report, which is better. This is what you want as a speculative trader. So right here, looks like my futures trade is taking off. Let's make some money, baby. You better, this little midpoint is kind of killing me, but this is just weird looking. I would have expected this to like recover after this. The market is lowering on something. And it's weird that somebody's pricing in something with their stock market being closed. But I'm going to hang tight on this. This was a trade for the bigger run up for the night. So we have a half day today. My target today is upper DD band. You know that. So at least to here to stabilize, like for here, right about here to stabilize. And then, at least in the overnight, we push. And then maybe tomorrow in the daytime session is that DD band. So I don't think we get it today clearly in this half day. But I think this was abnormal and it fell to a bull pivot. And I'd like to see us at least back to there to fill in that weird selling gap we had. Okay, so back to this. Essentially what this is going to tell you is how to predict the market. Very simple. The three categories here, commercials. A commercial is basically somebody that deals with the physical thing. It's divided into four categories. Forget about it. Merchant, producer, processor, user. Like in the oil sense, producer drills it out of the ground. Processor refines it into gasoline. A user uses the oil as it is. Like basically hard to understand. Nobody uses oil. Example would be oranges. Better one. Producer is a farmer that grows the orange. Processor is Minute Maid that creates the orange juice. A user is you at the grocery store who buys and eats the orange. A producer creates something, a user destroys it, and a processor changes it. A merchant holds it, trades it, or distributes it. So a merchant would be any facility that hangs on to it. Like Cushing, Oklahoma is a merchant for oil. It's a big distribution facility for oil pipelines, and they store a bunch of oil. Merchant. So yeah, this is like okay if you're like the guy that's like trying to sell oil to some refinery. You got a buddy with a tanker offshore. Yeah, this is important for you to know how they're positioned. The bettors and speculators and hedgers against the commercial. Someone that really wants to own the commodity and someone just wants to like speculate against the price. That's not useful to you because you are never going to cross paths with these commercials. So this choppy, nonsensical chart, especially in futures, index futures, this is a load of nonsense. It really doesn't really show you much. And that's why it's kind of a useless chart and people overlooked it. But people didn't understand that something that's a little cleaner and nicer, this little report at the bottom, actually has like trends. It moves up and moves down. It's nice and easy and clean and separated. Because what they did was they decided to take the speculative side of the market in this part and recategorize it into a useful thing for you guys as traders. And I use this to predict major pivots and reversals in the stock market on this data alone. See, what they did was they decided to tell you something that's more useful to you as an actual trader. You take the people and you divide it up into dealers, which are like, you know, swap dealers and market makers and liquidity providers. This is their position. Heck, they're showing you the market makers right there. They're giving it to you on a chart. They have to report to the CFTC. They require it. Asset managers, right? This is going to be your big institutions. This is your 401k, your mutual funds, your IRAs, all of that. Big institutions. These guys pretty much only long the market. That's a key to take. They're pretty much only long ever, and they're going to cash. Your 401k will never short a stock. Trust me. This green line, as you see, is this asset manager. And as you see, this is the net sum of positions where they are. And this is a big fat zero. Oh, wait, you can't see where that is. Hold on, move this to the right here. Sorry about that. This right here is a zero. And the trick is identifying where people are around this zero. So as you see in the zero, one thing you'll notice is that this orange line is practically almost always at zero. Great, let's forget about it. What is this orange line? Well, this is market makers. This is your institutions longing the market. Leverage funds are typically hedge funds that are using futures to short against long exposure in the other markets like stocks. The orange line is smaller regional banks and Fed banks. The Fed is in this orange line. Federal Reserve banks and stuff like that. Insurance companies, annuities companies, things like that. The smaller part of futures, it's forgettable, so forget about it. What's really key to note is that this green line is always extremely above zero, okay? And this blue line is almost always below zero, and so is this red. This is key to predicting the market based on positions, this alone right here. There are some cool things if you guys could grab that handout. Again, go get it. Keep it with you. Go to our Discord. I'm going to teach you some trading tricks after this too, but this is the icebreaker. Go here. All right. So here you can see that this is a pretty cool trick. Okay, so on this little handout, you can see there's some patterns to look at in the way positions are. And so what the neat thing is to see is that I'll show you some things to look for. And this will take with you. So this report updates once a week, and it tells like a week-old data, which is really nice. But let me show you what like a market crash and a market rally looks like from the perspective of the green, which is long only, right? Basically, your asset managers versus your hedge funds, the people longing versus the people shorting. If there's more longs than shorts, then the dealers have to take the other side of the trade. And so we'll do market makers here. Okay, so as you see, leading up in the 2008 crash, the market is rallying. And the longs are becoming more long. Pretty easy to see that. And anytime the market is pretty much rallying, you're going to see a trend that the long is becoming more long. The total net long position just gets bigger and bigger and bigger. Always supports a rally. So as you have waves of buying, you have waves of rallying. It's pretty easy to understand that. Another takeaway of this is that when people always talk about there's a high short interest that's going to push the market down, that's actually the world's biggest miscommunication of what shorting actually is. As a matter of fact, the short interest, like in futures, is this blue line. And as you see, the short is becoming more short, yet the market's still rallying. One thing that you'll take away from understanding this is that people shorting the market does not bring the market down. What does bring the market down is longs exiting their position. That's a really key understanding to know how markets move. When longs are getting out and dumping the cash, the market pushes lower. Getting out, like the net sum of position was long and less long here, markets pull back. So there's actually 4 different kinds of traders, and you guys didn't know that. There's bulls and bears. A bull will long the market, right? A bear will short the market. Okay. There's a bull and there's a bear. But there are 2 other kinds of traders that are never mentioned because people never taught this to you, and I'm about to teach it to you. There's actually a not part of this matrix. There's a such thing as a not bull, and there's such thing as a not bear. A bull is someone that longs something. A bear is somebody that shorted something. That makes sense. But if I was long and then I sell that thing, it doesn't make me a bear to take long profit. I'm just no longer a bull. So I'm calling like a not bull. And it's very important to understand the difference. A not bull, a not is somebody that converts shares to cash. And a bull or bear is somebody that converts cash to shares, basically. So a not bull is very important because the not bulls are actually what make the market crash, not the bears. And that's the one thing that, like, when I taught people, this is such a mind-blowing experience to them. Shorting the market has zero effect on the market as long as there's equivalent buying to go with it. So in this example, if the long is becoming more long and the short is becoming more short, the market always goes up because there's a buyer for every seller. And it brings you to the realization of liquidity. There's a buyer for every seller, the market is liquid. And one of the things is a takeaway is that liquid markets don't crash. And once you can determine the market is liquid, you can determine the crash is over or the market's going to continue to go. Okay. So the neatest thing is that it's the not bulls that crash the market. It's never the bears. If you are a bear and you're short and then you cover your short to make profit, you're just no longer a bear. The not bears and the not bulls are the people that pivot the market. It's not the bulls and the bears. They maintain the market. So bears just apply pressure, but it's very rare that the bears are contributing to the market crash. Very rare. As a matter of fact, the bears were short from 2006 and 2007 and more short and more short and more short. And for 2 years, the market continued to rally. You remember the big short with Michael Berry? Michael Berry was shorting the housing market for 3 years. He's not what made it crash, just having a short position. You know what made it crash? The value of the bonds crashed. People sold the bonds because they were worthless. And then the bonds valued lower and then his swaps went up. And so it's the people that dump their long holdings that crash a market. It's never somebody's massive big short on something that crashes a market. What I'm teaching does work with props. Oh my God, it works with props. I'm blindly longing the market right now based off of the results of this chart, and I'm proving it to you in this trade in the top right. So let me teach you something that's how this will work with props, Ayush. I got you. Great question. Great question. So I walk into the market every day with an understanding of something called greater market. I'm going to write it on my screen. And the greater market is just knowing like the taste or flavor of the market. And it helps me understand which side I'm going to take. I don't think I pressed the short button in about a month. Maybe once. But the reasoning for that is that the market is so insanely bullish from this chart and from our monthly maps tool that there's no reason for me to short. This is going to help me identify the trend and call pivots, bigger reversal pivots. So right now we're in a long environment. Even at the high, the market's going to rally from here with high probability. This all tells me that. So when I approach my trader funding program, right, I'm not walking in saying, let me short today, let me long today. I'm walking in and saying, let me long today. Oh, it looks like it's selling off. Let me sit out. That one choice is why I rock an 83% win rate right now. And if you don't believe me, here is the picture of that. And it's pretty common. So don't like, you know, let me like, well, let's try. People that have watched me trade since 2016 have watched my win rate go up. Even back then it was roughly 50%, but in the last, since 2019, my 2019 to 2021 era of trading, I was roughly 60 to 70%. From 2021 to 23, I went up from 70%. And now in 2024, I'm roughly trading 83%. I refine my strategy so much, but I'm very specific about what I trade and when I trade. So this is over a month of data, and I started trading with Tradeify a month ago. I made 54,000. I took 6,000 profit. So took 6,000 payout from this already. This comes from just longing with the right side of the market. And this is a huge decision for that. Looks like my trades are doing a-okay here. I like it. Pretty good. Okay. So one of the neat things that liquid markets don't crash, and that's like one of the major things that we have on this little cheat sheet here. Liquid markets don't crash. Whenever the blue is becoming more short and the green is becoming more long, the market's insanely liquid. Every single buyer has a new short, then markets stay stable. Doesn't matter how many people are shorting something. If there's a buyer on the other side, dealers never crash markets because liquid markets means that more trades take place over time, per time. And the more trades, the more money market makers and everyone makes. Like the liquid market is more money for the exchange, for money, everything. If markets are illiquid when nobody wants to trade, then everyone loses money. Looks like my long's taken off. Let's pocket it. This is a pivot off of liquidity as well. So what we specialize in is liquidity analysis, the real kind. There are people that teach you that they can find liquidity in candle charting. Absolutely not as good as this. This is a completely different level. I could calculate a liquidity point 16 hours ago. Actually, 5 p.m. yesterday. So actually that was, like 16 hours ago. And this line was handed to people. I just bought the dip here, and that's free money. Pretty nice. So I'll take it, right? It's a good trade. I like it. We're going to go, hopefully get right back up and fill this gap here today. Are relying only on DD bands, Geo, and overnight dynamics. That's right, man. That's it. That's literally it. The new stats on DD breaks. Yeah, John, let me tell you the stats after this. There are, and I don't know Ashton's technique and options ever invalidated. I don't think so. Like Ashton still does it to this day. I don't think he'd still be doing it if he wasn't having a good time doing it. His strats are really strong, using our techniques with his he had his iron condor and vertical spread techniques that he did were still pretty strong, I think, because I still see him doing it. Okay, so liquid markets don't crash, and that's number one point, and that's why I'm out there calling markets not going to crash and markets dipped. You ready for this? Remember in October of 2022 when everybody was making fun of me when they were like, "Oh, the market's going to crash and you're wrong, you weird bull. Yeah, you're just a perma bull. Like, what do you know, kid? The dynamics are so bad, inflation's so high, and this and that, and it's just like, this is the end. This is the end. We over rallied since COVID, and now we're going to tank, right? This is what people were saying, that here we overshot and it's going to sell off and crash. And I don't know, right here at the bottom, the principle of liquid markets don't crash is very true. Liquid markets don't crash, and tell yourself that. A liquid market doesn't crash. Now, again, let me show you where this was October of 22 right here. At that particular state, you had green going up and blue kind of going down. When you find buyers and sellers in this level of harmony, the market doesn't crash. Literally for these couple of weeks from the beginning of October here, from September to October. Actually, let me go out to like a easier. Let's see if I can get a better. I wanted to do week over week, not month over month. How do I do a 10-year? Oh, let's do daily. Okay. Oh, wait. Can't do daily. Weekly. Ayo. Okay, there it is. Okay. Let me try this one more time. Is my trade doing all right there? Okay. So right here, you can see at the bottom of the chart, I'm going to zoom in so y'all can see it. Positions don't lie. And that's the key takeaway, is that people can't lie with their positions. That's what they wanted to do. And right here, when I called the bottom for the year, from earlier, from the end of September into the beginning of October, that green was going up. Okay. And that blue was going down. This right here was a call. If you scroll back in my YouTube, you will see videos of my 1,200% gain in JP Morgan and 2,000% gain in Nvidia. I made 6-figure bets in Apple, Nvidia, QQQ, JP Morgan. Buying calls. That's it. I just buy calls and planned it. I made thousands of percent off of that call. Off of this one chart. That's it. That's it. Market. This plus monthly maps. It's a rocket scooter thing. So liquid markets don't crash. And literally at the bottom, the market was finding lower lows, and the bulls, the long side, this green line was flat. Does everybody see that it was flat for that month? Y'all see this right in chat? Throw some yeses in chat if you get it. This is 4 weeks of data, and for about 4 weeks, this didn't move. It was flat. Markets only crash when bulls are liquidating their long position. So like from here, when it's flat, there's no mechanism. Like the selling was over, and it was just volatile here. And then once I saw the shorts were going down and longs becoming more long, It's just liquidity came back, and liquid markets don't crash. They just don't. And that's like key takeaway from this little point right here, is that on our handout, liquid markets don't crash. Now, if that blows your mind, I'm gonna blow your mind a second time. Okay. Illiquid markets, that's what makes them move swiftly. Okay. So when you have the market going and like everybody's buying or everybody's selling, that's a whole different story. Where did my chart go? Okay. So what does a selling, market look like when everybody is selling? So let's talk about a liquid market, right? So comparing the blue and the green lines here, you see there's a period where like the blue and green are fanning, pinching together, pulling apart, pinching together. That's all fine and dandy when they're doing this or this alligator fate, like alligator. Remember, like the alligator mouth. Okay, this is liquid. This is illiquid. YMCA. All right. Now, from here, does everybody see there's a difference here? Now, this is a big deal. Green is going lower, blue is going lower. We can all see that here. Illiquid market from here until here. Actually, no, until here. Illiquid market. Actually, let me draw it a little better. Illiquid market. The moment in time where they both are pivoting down is about right here. And the minute they both start fanning out again is right there, exactly right there. So we're back to being liquid, right? Liquid and liquid. This is illiquid, and illiquid markets are your bear markets. That's it. Positional data doesn't lie, and this is the best part about positional analysis. Like I said, we're pioneers in the field of positional analysis. If you guys love coming to YouTube and watching free traders, like this is education like we do every day, but I always am live trading as well. But if you never had anybody teach you this kind of stuff, we're glad we teach it for free. That's why you guys come here every day if you like. So this is pretty cool, right? Periods of illiquidity are when markets come down. And you see slight overlaps when like right here you had some green selling and some blue selling, and it kind of overlaps in here. And that matches a little bit of that downturning market, right? Now, COVID is an interesting case because the COVID was very liquid until an event happened where everyone just liquidated their longs in excess of the blue. Now, one may say, aha, well, that's liquid. They're pointing together. And you're absolutely right. That's why the COVID crash was such a short-lived thing and not a bear market. And we're filling the gap right here at the top. Let me go ahead and take profit on this. Let's just cash out on this. Alrighty, we'll take the money there. I'll take the money there. This is cool. I think I'm okay with this trade. Oh, wait. No, that's not the exhaustion candle. I should hold on a little bit more. But you know what? Let me focus on the class. Let me take the profit there. That's good. So that was a lot of money. Thanks for tuning in, guys. These are the accounts. Remember, I took a little bit of loss at the start by getting in and getting out and getting in. So the actual net take home was 8. What is this? 14, 22, 23, 27, 3,000. Is this $3,000? Just chilling. Okay. Not bad. Woo! Best to ever fucking do it on YouTube. Let's go. I'm just kidding, but not really. This is a pivot that comes from our platform overnight. This is all positional data. Okay, going forward, let's go ahead and make this full screen. I'm done trading for the day. But I mean, I still want the bigger trade for later, and it's still probably going to go up. I just have limited. I can only make $1,000 per account to maintain consistency. So once I get close to my 1,000, I do need to close out, by the way. So Tradeify has a consistency rule of 20%. So I'm on second payout, which means I need to make $4,500 at 20% consistency, which means roughly my trades need to be about 900 a piece, and I'm totally good. If I go over 900, I bust the consistency. So that was just enough to get inching right up to it. Now these two were actually much lower. I think I only traded 2 on those instead of 3. But either case, money's money. Okay. They're all $150K, $150,000. There's 5 of them. Straight to funded accounts at Tradeify. And I'm going for my second. So I started with them, and within the first 10 days, I got my first payout. Like a lot of these prop firm warriors out there are gonna be people that do like thousands of prop firms. They blow up, then finally make a payout. And maybe they make $1 million or $100,000 or whatever, but they probably spend just as much on these evals. I went in at Tradeify. I started on day 1. 10 days later, I got a payout. That's it. That's it. That's literally it. I scaled. No, I manipulated my cost basis to get it to right my pivot. So yeah, in 10 days, I didn't go in there. I'm not blowing up a bunch of accounts. I've spent very little with these guys. All right. No, he's saying how did I leverage up? What I did was I longed here, and then when it fell to here, I added a whole lot at the base. I went from like 1 contract to 3. And then right when we got up to my profit target, I closed out. I would normally hold to fill this spot right here. But yeah, I have to minimize how much I win. With prop firms, you can't win too much. That's the crappy part. Consistency rules keep you in check. So I can only make $900 per account right now. When am I coming to Top Step? So yeah, I've been invited to check Top Step out by some of the traders on the show. They keep telling me, put in the work at Top Step, and if you start, crushing it over there, we'd love to get you on the show and this and that. So some of the people on the show I'm friends with, and I was like, okay, I'll try it out, but I haven't put any effort in the Top Step. I was focusing just on this Tradeify for lately. I'd put in some on Top Step about a month ago, but then once I started like what I like to do is focus on one and get everything going. But now I finally set up my other computers over here so I can try to do like Apex and Top Step as well, because I ran out of screen space. And plus I don't like, these prop firm dudes do like prop firm arbitrage, which is a really shady thing they do. You see anybody out there that's like trading on like 10 different prop firms and every day they seem to win in a different one? Prop firm arbitrage is something that some people do and that you get accused of if you're doing prop firms. That's why I don't do it. I'm not accusing anybody, but I don't want to be accused of it. That's why I focus on one on the stream. Prop firm arbitrage is pretty easy. I go pay $3,000 at one prop firm and $3,000 at another, get funded accounts in both places, and then I just go in there and I fucking long one and short the other. It's totally easy to do. And one of them blows up and the other one makes 30 grand. I had to show you the winner. And I'm like, here's my take profit today, guys. Here's my Apex today, guys. Here's my, and every day it's a different one. Every day it's a different green. But what's hidden from you is the amount of money they spend doing this and how the net profit is actually maybe 20 or 30% of what is advertised to you. So I focus on one so I can show the history of one. That's different than any YouTuber out there. So you can see this is the guy's history in one account. That's it. So I'm not out there posting different results from different accounts. So you can see night or day difference. I post my Tradeify results every single day, up or down, up or down. Mods, thank you for answering the questions in the chat, because I know I'm like balls deep in this education here. But if you have questions, feel free to ask them. I'll try to answer them while we're chilling here. Imagine getting $3,000 in 1 hour. Yeah, well, if futures trading, when things line up perfectly, most of my trades are 10 to 15 minutes a piece, and I only make a couple a day, and I'm done. So imagine making, I've had my last Friday. Let's show you guys my last Friday. Friday I made 5,600. Thursday I made 75. And most of those trades are about 6 minutes long, 6-7 minutes. They weren't that long. Just imagine making 7,000 with like 15 minutes of work. But don't let me lie to you. It's hours and hours of planning and waiting for the 15 minutes of work. But I'm waiting to execute at the right spot. This is the trick we teach at Rocket Scooter. This is this right here. And by the way, we do have a boot camp that teaches trading. It's by far the least expensive boot camp for trading on the planet. Let me shamelessly plug it really quick. Check this out. You ready for this? If you guys like the quality of the Commander Traders Report, imagine if all the stuff we teach in day trading. Now again, I'm not a course salesman. I make a fortune as a trader, literally a fortune. I drive a Maserati. My girl and I just bought $1 million house. We have a pretty nice life. We travel, we eat, we get bottle service. We do all the things a trader should do. I just don't brag about it, but we live the life that most traders would. However, it's not off of selling a course. My courses cost $1. That's it. It's literally $1. It's enough that you take it seriously. There's 20 courses and it's 20 days. And I actually do train on trading. This is one of the class focuses is just this bonus class that teach you this. But everybody that has taken our classes, for the $20 it costs for an entire 20-day boot camp, $20, that's it. All that money actually goes into paying the girl that makes you guys these handouts. She's a young person, her young 20s, and film and television major. So, you know, what little bit we make from that, we give it to her as her salary. And so I make absolutely nothing on these courses, by the way. So I'm not a course salesman. I make money trading, but we want to train you guys. I actually sell the platform. I'm the CEO of the company that made it. So these are the reviews. It's, you know, these are people that actually took it. This tells you what they bought. They all took the class and they all left reviews. This is like the last 6 months of reviews, and this 5-star, 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 5-star. Game changing, completely changed the way I look at markets. After Matt's lessons, became a consistent trader. Now, let me tell you, just preempt this legally. I'm not telling people to leave reviews. I'm not telling them what to say. I'm not incentivizing people. These are actual testimonials of folks, and I haven't verified that they're true, but they say they're a consistent trader, so that's their testimonial. These are not, you know, endorsed by us, or, you know, authenticity is not checked, but these are actual users from chat. Game changer, stuff like that. There's really, I'm gonna tell you that people that have taken the classes have said that by far, I quoted somebody last night, they tweeted like, how's this only $20? And it's because I don't need to sell trading courses for a living. I think that's goofy if people do that, but you know what? People do that, and you're making their Maserati payments, I guess, but there's the link for it. I don't know how many guys drive Lambos thanks to your $1,000 boot camps. I don't know. It's big business. I just never was one to sell courses. I think it's kind of silly. Unless you have something really good to teach, and like I said, I don't want to be out there as anything good to teach. There's decent stuff, not bad stuff, but what's being taught and sold usually you can learn for free. So, so this Committed Traders class, this is one of the 20 classes of the boot camp. This is barely scratching the surface, but you find out that like liquid markets don't crash. That is one of the major understandings of finding liquidity. And if you can find liquidity in any way whatsoever, liquid markets don't crash. And when markets are quote unquote crashing, Papa Bear's buying the dip because it's liquid right here. And I know it's liquid. And in another class, I teach you why. Liquid markets don't crash. They just don't. They never do, and they never will. Because market makers don't want to crash the market, and I'll tell you why. Because in reality, the way market making works is that a market maker is just an entity that signs up voluntarily to take the job. They get paid by the exchange a maker-taker fee, which is a portion of the exchange fee you pay. You ever bought a futures contract and you looked at it and your broker took a cut, the exchange took a cut, and the NFA took a cut, all these fees, right? Clearing took a cut. All of these fees go up the ladder. And the exchange takes a certain amount. Let's just, for the sake of argument, say the exchange takes $1. Of that dollar, the exchange is probably going to give like 0.03 pennies or something like that to the market maker. And all a market maker is an institution that signs up to do one thing and one thing only. Literally one thing and one thing only. Market maker's job is not to sweep your stops or, you know, run your candles or test the lows. Market makers don't do shit that people think they do. There's so many salesmen out there that sell market maker ideas that have never talked to market maker in their life. I have buddies that I go drinking with that are fucking market makers at Chase. Like, these are people that do shit like this all the time. And they laugh because they're like, we don't use charts. Like, what? Like, all of our stuff is algorithmic. It's an order flow. We look at the supply and demand and we quote accordingly. Like, that's it. I make memes about it all the time. You know, market makers don't even use charts. It's not like a guy sitting there like, let me sweep some candles. This is baloney taught to you by course salesmen. A market maker has one job and one job only. It's to put an order at the bid and an order at the ask together in one chunk. You submit what's called a tandem order, where you say, like, you could put a limit order right here and submit, and it's there on the books. But a market maker must apply a limit order to both sides of the books, and that's all they do. They quote here and they quote here. Market makers don't move price. Their price is a natural thing of market orders hitting the bid and ask based on the available supply. Market makers can only move where they're going to buy or sell. That's it. They don't control price. There's no price to control. Price is a fugazi. Price exists by the last liquid trade between two traders, a willing buyer and a willing seller. They create the market. Market makers just buffer the buying and selling by being on the other side, and they get paid a fee if their order was on the books at the time the market order fills. So if you throw a sell order right now at the market, whoever is on that side of the bid takes the order from you. They get on the other side. If it happens to be a market maker who's drawing a cage around a certain area, then they get paid an extra fee on top of it. As a matter of fact, if you short and a dealer grabs your short by longing against you, they're going to long against your short and go buy some puts somewhere else. Well, now they just gave themselves a neutralized trade. Puts make money when markets go down. Longs make money when markets go up. And if they balance it just right, it's a neutral trade. And they'll neutralize that trade all day long because every time they engage in it, they're going to make a couple of fractions of pennies on the dollar. And multiply that by millions of trades per day, they're going to make a fortune taking absolutely no risk in the market. Commitment Traders has a week delay. That's the one thing about it. It's not an actionable chart. It's a history and a story of the market chart. Okay. So a market maker has no desire to run stops or collapse the market. If they nuke 10,000 traders by, running stops, which I hear people say market makers run stop, and I vomit in my mouth, and every market maker laughs at you for believing that. Because if a trader goes bankrupt by running their stop, then that trader lost all of their money. Say a trader has $100,000, right? And the trader goes zero there. That $100,000 goes into the pocket of another trader, and the market maker made 0.03 pennies or whatever it is off of them. But if the market is just liquid and that $100,000 trader is just whittling their trade away, they're trading back and forth all day long, and even if the market's flat and they don't lose anything, their account slowly deteriorates and goes into the market maker's pocket just by participating. It's an ante-up like in the casino to play the game. Just by trading, you're going to pay a fee every time you trade. They have the most financial incentive to not squeeze traders out. Do y'all understand this? Yeah, market makers don't run stops like predatory hedge funds and traders do. Does this make sense to you guys there, right? They have zero incentive to run your stop and make you lose your trade and blow up in a single trade. They'd rather you trade 1,000,000 times and make money or no make money. It doesn't wait. You're going to pay $1 every time to the exchange you trade. And everybody, including the exchange, has financial incentive to have traders just trading back and forth all day. If the perfect situation is the market is perfectly flat and people are buying and selling all day long and the market goes nowhere. And boy, oh boy, that's free money for the exchanges, right? Because they're just raking in those fees all day long. It's like the casino has every desire to keep you in the game for as long as possible. Remember, they used to I think they charge for drinks now, but they used to give you like free drinks and free comps and all these shows to keep you playing the game. The more you're playing the game, the more the house rakes in the money. So the idea is not that the market makers have any incentive to run your stops. You just put your stop in a place that got stopped. There's no evil incentive for people to remove liquidity from the market. They'd rather traders stay in the game and make little to no money from each other, and the house just takes in the fees. They don't want to bankrupt their own dealers. They want to keep the games playing. So the idea is liquid markets don't crash. And number two, that's even better, is that not only do liquid markets not crash, but the market makers themselves are very important in this equation. If the dealer position, the dealer and swap dealer position intermediaries, down here the red line, in the history of this chart, as I showed you, illiquid markets are markets that crash when the not bulls and the bears all line up. Not bulls are selling longs. Bears are shorting the market. When everyone's double dose selling, the market pulls back. And when everybody's selling, the dealers are the buyer of last resort. Somebody's got to buy, right? And you'll see this pattern a lot, is that the green line will be sloping down and the blue line will be sloping down and the red line will be going up. The market makers that are normally negative now hold a positive position because everybody was selling and they're the buyer of last resort. So this leads you to one other conclusion that you can see on this, is that the market makers themselves, at least in futures, are almost always maintaining a net negative position, which makes a lot of sense. Because why? Well, stocks always go up, right? The stock market is always going up because the net long is always bigger than the net short, almost all given time. There's always like 4 bulls for every bear, maybe even bigger. So if this was 0, the amount of bulls right now is 934K. Okay, that's a lot. That's pretty big. And if you subtract the absolute value of the amount of bears is 357 negative, you can see that there's a net deficit of roughly, 580,000. Okay. So there's always more people longing the market, engaged in long positions, than there are speculators shorting against the market. For the most part, in the futures market, this is reflected by the hedging against other positions, but this reflects the risk in the stock market as well. There's always more longs and shorts. And you know that because the put to call ratio is almost greater than 1 in a bull market. Because if there's more longs than shorts, then there's more insurance against those longs than there are insurance against those shorts. So you'll notice that when people say, well, the put to call ratio is really high, maybe the market's going to crash. Remember, I told you, it's not people betting against the market that makes it crash. What makes the market crash? I want everybody to type it to make sure you learn this. Matt is locked in right now. Baby, I'm on it, LaMelo. I love, this is one of my favorite classes to teach. It's not people betting against the market that makes it crash. What makes it crash? It's when the not bulls, when bulls are selling their shit and there's no liquidity, then markets crash. Markets crash when there's no buffer to catch the selling. So when everybody's selling and the only buyer in town is the dealer, well, they get to set the price because the dealer only quotes the bid and ask. Well, shit, if everybody's selling, let me go ahead and quote the bid really low and buy wherever I want to buy. If you're the only buyer in town and everybody's selling, then don't you get to set the price? Therefore, you'll set your price lower where you decide to catch the ball. And that's exactly what they do, right? Illiquidity. You guys nailed it. Y'all are so smart. Okay, so in this particular sense, because there's almost always more longs than shorts, the PDC ratio is pretty much positive in a strong bull market. You'll see that one interesting phenomenon is that when everybody's selling and markets are illiquid, sloping down, it can sell off just enough that the dealer, who is the person that's catching the supply, and they're the only person with demand, the maximized demand is with the dealer. On the other side of the coin is when the maximum supply is with the dealer. And let me teach you something about supply and demand in the market. See, there's an adage that you'll have to understand. If you want to, on a sticky note, write this down by your computer. This is exactly the key understanding of the market. In general, and I want you to give me an example in chat for this particular thing. The saying is, he who holds the supply owns the market, sets the price of the market. Can you guys give me an example of somebody that owns the entire supply of something and therefore they can set whatever price they want? You got any real world examples of that? I'd love to hear it. He who owns the supply owns the market. Diamonds. That's a great example. Ollie nailed it. Diamonds, right? De Beers, they artificially set diamond prices to whatever they want it to be. Venezuela with oil, shit like this, right? De Beers diamonds, right? OPEC, a great example. Saudi Arabia decided to flood the oil market. OPEC decided to pump at full capacity to crash oil from $115 down to $26 back in 2014, 2015, just to squeeze us out of the market. Just by flooding the market with supply, you could set the price to whatever you want, right? OPEC used to have a lot more power than they do now. The NOPECs and the BRICS and all that are getting a lot more powerful. OPEC is roughly a third of the global supply right now. As Russia and the United States have stepped up their production. But back in the day, well, OPEC had a really big stronghold in the price of oil, especially when it gets up to $70 or $80. They can knock anyone out of the market if they want. They have enough supply and reserves to really do that. Anyways, yeah, if you own the supply, you can set whatever price you want. That's basically what you can do. If you flood the market, you can crash the prices. If you throttle the supply against the demand, you can raise the prices. And the two examples are OPEC can decide to crash oil prices if they want or starve the supply to raise the price. De Beers is practically the monopoly on the world's diamond mines. And so, you know, these guys can set the price of diamonds. That's why you pay so much for them, because they created this market for you. And it's all fugazi. It's all fake. And here we go. If I was still in the trade, I'd take it. But today's particular setup is to go back to this weird volume that we had that made no sense. And that's basically the end of that trade. I don't know. Did anybody trade today? I'm in and out. I made the money, baby. I'm good. Okay. Matt with Rocket Scooter. Mooney, you're hilarious. Okay. So anyways, if you own the supply, you set the market. And so the key point, and this is how I called those bottoms, and everybody was like freaking out. See, one of the neat things about the, and I like to quote The Big Short because it's the best way to understand. You guys remember The Big Short when Christian Bale, who played Michael Berry, you know, went to the banks and he's like, you know, the mortgage bonds are worthless and I'd like to short them. And they're like, well, Mr. Berry, you can't short a mortgage bond. There's no way to, or you can't short the housing market. There's really no instrument to do it. And he's like, yeah, well, I want you to create an instrument so I can short it. And they were like, oh, well, I mean, sir, it's the mortgage market. I mean, if I mean, it is Wall Street. We'll take your money if you want to. And then they made a credit default swap. What a swap is an instrument where it's insurance basically. You buy like an insurance policy for your car. It's a swap. A swap is where you exchange a collateral with somebody. You pay a monthly payment based on your risk. If you get in a wreck or get a speeding ticket, your monthly payment goes up. Well, swaps are the same way. The value of the underlying asset and the risk that goes with it are valued in this swap. You exchange money in the event that something happens contractually. When that thing happens, you get a payout. You have to pay a monthly fee to do that. And a credit default swap is a fancy word for your Geico policy. It's a similar thing. You're betting, you're buying insurance on a bond. If the bond were to deteriorate in value, i.e., you're buying insurance on your car. If your car were to deteriorate in value, like you fucking wrap it around a telephone pole, you get a payout. Well, the same thing happens. You're buying insurance on a mortgage bond. This is what the housing crisis is all about. And the mortgage bonds were these like bastardized versions of themselves that were wrapped up and rebundled and wrapped up and rebundled. And the credit ratings agencies were actually bribed to not value the bonds appropriately, but to use a diversification model that valued them at AAA when they were full of nonsense. And all these smart traders saw it, and they decided to short the market, but the market didn't crash. Because I think he started buying his position like in 2004, and it wasn't until, I think, was it 2007 where it finally started realizing, and in late 2008 is when the market actually crashed. It wasn't the big shorts, the billions of dollars of shorts that these traders pumped into it. The market was slowly starting to deteriorate right inside of here, but we didn't actually get the crash with Bear and Lehman until like, late 2008. So while he started building his short in 2004 and had to pay like, what was it, like 60 or 70 million in collateral every year for these bonds, he ended up making billions of dollars on the trade. But boy, it was like a huge problem because just shorting a market doesn't make the market crash. As a matter of fact, the movie kind of romanticized the whole thing, but it really was accurate because it told you like the whole point of it. The banks were actually, kind of bribing the credit agencies to rate these ratings, S&P and Moody's and all that, to rate them as good bonds when they were actually crap, to buy themselves some time until they themselves were able to short the market and get out of their position. Once they realized they had a crisis on their hands, the banks resorted to criminal activity to get out of the way before the fall. And it leads you to the one final thing to understand is that, see, the people that are buying and holding these really disgusting, shitty mortgage bond package instruments were all these investment banks. They're the ones holding the bag. And the final key point of understanding how the market works is that when the market makers are holding the bag and they set the market and they're the only person in town holding the supply, he who owns the supply sets the market. Do you think for any reason at all, they're going to go out there while owning the entire supply and then crash the market on themselves? Insanity. They held the supply of these mortgage bonds and stuff, and then they held the risk on them, and yet they were trying to bribe and fix the market. Even the natural market was taken over. See, even resulting the criminal activity to control the market. When they're holding the bag, they're not going to crash it on themselves. So even a natural mechanism, when the market makers are net long the market, and they're the only buyer in town, and they own the supply, they can set whatever price they want. And they're certainly not going to set it to zero, because why would you go out there and buy every last, Beanie Baby on the planet in 2001, and May of 2000, you bought all the Beanie Baby bears and you own them all. And now you have all the collector's items. Everybody wants them in the height of the demand. You bought them all. And now that you own them all, for some odd reason, you detect that the market might be falling. So you decide to price them at zero and bankrupt yourself. How goofy does that sound? So if you own the supply and there's demand, you set whatever price you want. And certainly, if you own the bag, you're not going to set the price at zero, which has everything to do with if the market maker's position is greater than zero. In the history of the commitment traders, the stock market hasn't crashed one time. Not once. The dealers are holding the bag. They'll do whatever it takes. because they decided where they bought it when everyone was selling. They set the bid wherever they wanted to catch the ball. And then when everybody's selling to them and they hold a net positive position, at that moment in time, the market has pivoted up every single time. Every single time. That's how I made those big ass calls and bottoms. I call bottoms markets all day long with this. So in the history of the market, when the dealer position is greater than 0, the market hasn't crashed once. A scare has warded off. You guys remember the flash crash in 2015? Here's the flash crash. Everybody's like, this is the end. The market's going to die. And the dealers were positive and the market somehow fought off the crash. Why somehow? Well, they'll resort to anything to not bankrupt themselves. And certainly if they're the only people long the market and everybody's selling to them, they already dropped the price to account for that selling. The liquidity that they provided was here. So markets were liquid here. They were the liquidity provider of last resort. So liquid markets, again, don't crash. And they doubly don't crash when it's the market maker providing the liquidity. They never crash. And enter COVID. I mean, anywhere on this chart, when the dealer intermediary position is greater than 0, the crash stops, the fire's out. Every single time. Here's COVID. COVID crashed and COVID recovered half, and everybody goes, yep, we retrace half, we're going to sell. And then you and me come over here and say, well, no, the dealers are positive. Isn't that wild? Crazy, right? Market went up. There's a thing you need to understand about the mechanism of markets. So nothing here is talking about candles and engulfing candles, right? These are actual reportable positions. It's an observation that I made a long time ago. And it's a very, 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 very awesome observation I made. It's made me a whole lot of money, guys. I'm the guy that usually everyone thinks I'm an idiot until I'm proven that I'm right. Here's 2022, the big recession that we had. You guys remember that? Remember at the top when I showed you that chart and I was like, you know, the market looks like it's going to sell off. You remember here? You remember right here when I said it looks like we're in for a correction right here at the top of 2021? Now I'm going to show you guys. Notice anything peculiar about this map right here? Let me circle it. Let me square it off in a better spot. You notice anything peculiar about like right here? Do you notice something right there? About the green and the blue lines? Y'all know, you notice a little bit? And the early warning signs that we had right here for the same thing? Sloping down, right? So you had real illiquidity starting to build up here, and then the bear market started. One of the things we saw was that the market was a period of liquidity as we popped to the high, and then the very next week, both the data points are going down. Okay. And then when we got down to here, you remember my tweet right here that says we're in for a 2-month. Now the timing comes from one of our tools down at the bottom. Here's to a 2-month bear market rally. I must have found some liquidity down there at the bottom when I circled that and made that tweet. Well, here it is. Do you guys notice something very peculiar about this line right here? What do you notice about this point in time for my 2-month rally? Y'all notice something peculiar right there? Alligator mouth. Baby. Boom. Like that. Y'all notice that? I found liquidity like a month before I made the call. I said the liquid market all day long. From exactly here. And I think my tweet was right there. Liquid markets, they don't crash. And so, and a final note for this one. It's a fun lesson. I love it. And over here at the bottom. This is the bottom for 2020. Literally here, I said 2 months. Now, we have a tool that lets me time how far a rally is going to go. Monthly map, I'll show you that in a minute. But here, and it's all positional data. It's all we're looking at is just positions. There's no magic here. I'm just looking at people's positions and how they change. If somebody's less bullish over time, they're going to be selling their longs. I mean, that's easy to see. Now right here called the bottom, exactly there. All right, everybody. What do you think we're going to find if I go back to Community Traders? If I show you the chart. What are we looking for in October of 2022? Is there a certain word that begins with an L that we're looking for? And call a bottom when everyone was like, this guy's stupid. Who brought him into this podcast? Permabull. How long are you, Mr. Permabull? It's like, guys, the positions are, it's just, I can't explain it. They're like, well, why is the market going to rally? I said, I don't care why. It doesn't matter why. Whoever's buying the market has a reason. They're smarter than me with more information. I don't know what it is, but there are people buying. The market's extremely liquid here. And liquid markets don't crush. Like, yeah, whatever, kid, whatever. What do you know? And all the big wigs around there. Like a lot of big people around. These fundies were there. And so, anyways, I don't know if you can tell what the shape of alligator mouth is at that point in time. That started out being liquid right about there the week before I made the tweet. You notice something else peculiar. Not only is the market liquid between the net speculative long and short side of the market, but tell me about the dealer position on top of that. The dealer position. Tell me about that red line. Is it above zero or below zero? What do you think? Above zero, below zero? It's above zero. They both lined up. And on that podcast, boy, I had a hard time explaining this to people because no one knows what this chart is. These people are like fundamentals. They write newsletters and sell them for $19.99 a month. These people are idiots. They don't trade. They make money selling bear news. And they get so loud when the market's bearish because everybody in this world only chimes in. Like 99% of traders are like average folks that invest in their 401k. And they only really pay attention when the market's crashing. And then the newbies go in there and they're like, I want to learn about the stock market. And boy, newsletter sales like to go up because these people love to sell fear all day long. Like every time Apple has earnings that's good, it's like, is this too good? Be careful. Every time Apple comes out with a new plan, yeah, Apple's building new phones, but how much is that going to cost their bottom line? They're always trying to sell you the idea that good news is bad because people are fucking knuckleheads. They couldn't, like I say, they couldn't even trade a bottle of water to a fucking dying, thirsty guy in a desert. They'd still fail that trade. I don't know. And so anyways, these people just sell fear, and bears are the goofiest kind of people in the world. I'm bearish when we need to be. I'm always, a good bull is only a day late to a bear party, but a very good bear misses out on years of gains for being bearish. That's like the best thing I always tell people. I'm a bull until the bear market comes, and I'll know the very next day. I'll miss the first day of the market and bear market. I'll jump in the second day. I'm never late by more than a day on a bear market. But a bear is like, trust me, it's coming. It's coming. It's going to fall. Just hang it. I just want, oh my God, I'm right. Look, I nailed it. I'm right. Buy my newsletter. And you're like, you didn't even trade it, dude. You just basically, you were the person that like invites people to a party at your own house. And then you call the cops on yourself because the music's too fucking loud. That's how these bears are. They ruin their own party by just being like the least fun person in the fucking room. Like, seriously? I like to make a noise complaint. Yes, sir. What's the address? Well, it's actually at my address. They're playing the music too loud downstairs. Can you come turn it down, please? Sir, can you walk down and turn it down? No, I don't. I'm not good at socializing. I don't want to cause a scene. So yeah, anyways. So point I'm saying is, goofiness aside, the market is almost bullish most of the time. It usually is. And there's ways to detect when it's not bullish and be very understanding of that. Illiquid markets are crashing markets. And when dealers are positive, the fire stops. It really much is. And at this point in time, you had everything lined up. You had your alligator mouth and you had your dealers greater than zero. It was by far the perfect lineup of all things for me to say that's the bottom. This is such a powerful thing that when the light goes red, we actually got the signal of dealers being positive at the first 2-month bottom that I call. Dealers went positive there. And then the bottom, dealers went positive there. It's a beautiful thing to see that when the dealers are holding the bag, just like the bears, they can set the value, whatever they want, and they're not going to devalue their asset to zero and bankrupt themselves. It's the goofiest thing in the world. Now, let me tell you something pretty cool about COVID. Allow me to introduce you to more, 2008 level corruption. This by far is the interesting, and you wouldn't have even known this happened unless you were studying the community of traders. Now, we do, because I train all of our traders. We have 10,000 users of the Rock Scooter platform. We're in the biggest futures trading communities on planet Earth. And these people all know this too. We watch the community of traders as part of our weekly routine. We look at it once a week. But for the longest time after COVID, we rely on our updates to understand the state of liquidity. Now, in this particular case, after COVID dipped and started rallying, you had your alligator mouth right here. This was kind of okay. right? It's flat and getting slightly bigger, but the dealers were negative. And we wanted to see the magic lineup of dealers being positive. And the interesting thing was that for about 6 weeks inside of here, do you notice how from like here to here, it's this weird looking line where it's like, it just kind of looks like this. And then all of a sudden 1 week, it's like this. And 0 was right there. Oh boy, let me tell you about some more corruption shit. I'm about to teach you something. That this'll let me delete that because that kind of looks part way like the symbol you're not supposed to draw. Let me put a little dash line here. Let me delete this. Let me just not draw that. Okay, let me draw something like this. And then let's just pretend there's a leg there. Okay, so, you know, I don't want to get Elon Musk here. But either case, right here, you get this idea where the market somehow goes from negative to positive in a single bump. And for about 6 weeks, the CFTC was like, we have an outage. For some reason, we can't give you the report. And we were like, but the dealers are like close to 0 and getting better. We need these updates. And for 6 weeks between here and here, there were no updates. Then all of a sudden, right here, the updates of all the weeks came in and we got them all at once. And somehow through this particular thing, the banks somehow, and I can't tell you how it happened, whether they hired some hackers to bombard the system or they did it themselves or there was corruption or whatever, but somehow they managed to ninja themselves into a net positive position when everybody thought this double top was going to crash the market. And when Biden won the election here and was going to be president, somehow the banks snuck into a long position magically in the 6 weeks that the CFTC wasn't giving us this report updates. Then all of a sudden they did. The flurry in our Discord was like, dealers are positive. Dealers are positive. What the fuck? The market's not crashing. Where did this come from? How'd they go from minus 200,000 to positive 200,000? 400,000 contracts snuck in that 6 weeks period. And this whole time, the market was trying to sell off, and we wanted that answer. Is it liquid enough? We're like, I don't know, because it's illiquid again. The longs are selling, and the shorts are shorting, and the dealers are still negative. Oh my God, it's probably going to sell off again. And then all of a sudden, when all the reports came in, the market magically was liquid. It was like illiquid in the dead space, and all of a sudden extremely liquid. Like somebody did something so they could, as y'all see this, right? They could sneak into a position. Everybody in our Discord, we all talk about it still to this day. It's another piece of evidence of some kind of shady behavior of somebody somewhere doing something. Do you guys see that, right? Imagine every day that we want to see our alligator mouth and dealers positive. And at this, you got to zoom in to see it. But this week was particularly bad because people were saying like, we might get a vaccine. No, we might not get a vaccine. And people were still kind of scared of COVID and thinking it was going to shut the market down again. And again, right here, you got to zoom in and see it. The green and blue were both sloping down with the red less than 0. That is recipe for a extremely bear market. That's a crash market recipe. Okay. Dealers are negative and everybody's selling. This like selling this week, now it might not seem like a lot to you. 200 points on the S&P is a lot. These are 6% moves per day relative to today. 6% move on 6,000 market is 360 points. So imagine the S&P moving 360 points, or the Nasdaq moving 1,200 points in a week. Okay, I mean in a day, the S&P was moving equivalent to that back here. And we were like, holy crap, the market's going to crash and it's illiquid. This ain't good. But lo and behold, for 6 weeks, the banks were capturing all that selling and sneaking in as liquidity providers and somehow not reporting their position that they had switched the polarity of their position. And then right here, when all that back data came out, right here, the market was magically liquid. And after a week of selling, all the bears were like, it's going to sell. It's the crash. And we're like, oh, wait. No, you got your alligator mouth right here and dealers are positive. This is the start of the rally. And it was. And the volatility tightened up and the market somehow revealed its hand. This big ass volatile week somehow tightened up. We had a nice, easy, clean couple of months after that. Liquid market, alligator tooth, alligator mouth, and dealers greater than 0. They somehow managed to create an illiquid scenario so that everybody can sell to them and they can capture all that liquidity in a nice tight spot. Somehow hide from Wall Street that they were doing this, and all of a sudden start quoting higher when people that were short started covering their shorts so that they can actually buy at the bottom, and that was the bottom. It was the craziest thing I've ever experienced, and it's like pretty neat to see this because in our Discord we were like, we're the only people that see this. This is the start of the rally. This is the start of the rally. At the top, the banks are zero greater. This is the start, and the market cleanly rallied for like 3 years. It was incredible. And it just kept going. It was like, how many people right here in this little choppy week, and trust me, if you were trading here, you remember the news. Banks are predicting a 20% correction in the market. Nah, the market can't even break the highs. Market's double topping. And we're just like, this red line is above zero. This is the liquidity is gonna completely come in. The volatility is gonna drop. We're gonna rally. And we did. So anyways, yeah, these little sneaky snakes here. Now, whatever they did to hide it, they just did it. But you will always know the truth of the market. Now, here's the best part. Let's take what we've learned today and see what kind of market we're in now. We got to determine two things with this report. Are we liquid or illiquid? Who's in control? And where are the dealers at? Are they the ones providing liquidity? Let's find out. Let's go to today. Let's see where we are. Market's rallying at highs. We've had a choppy December and a choppy January, and Fed's doing this and who's doing that. Are we in a bear market, guys? Is this market about to crash? Well, let's take a look. Green is sloping down, and blue is sloping down. Since about here, it hasn't been looking good. And as a matter of fact, it still doesn't look like it's getting better. Now, I'm not bearish the market, but for this particular period of time, it was very illiquid, okay? And that's why we've experienced the two choppiest months you've seen in like 3 years, right? Again, illiquid markets lead to weird volatility like this. Remember, liquidity is the inverse of volatility. If the market is illiquid, there will be volatility. Market overreacts to catalysts. This is Nasdaq futures. You guys remember every Trump tweet on tariffs, and every single time Powell opened his mouth, the market was just crazy volatile these last couple months, right? You can almost see a difference between those huge gap downs in futures. You can almost see the difference between like, and they appreciate you guys sticking here with this education. And the market's closed. We're having some fun. I made about $3 grand today trading, and you guys are, it's a free stream. I stream every single day. I've been trading since 2016. We're pretty big in the futures world. You guys are welcome to join us every single day. I do live trading. I'm going to try to make this year, my goals this year is to make 100,000 ETF, 100,000 Tradeify, and get on the top step leaderboard. And I'm trying to do that. That's like my new goal. So I'm getting my way there. I'm a live funded trader with ETF. They promoted me to live. I'm up $50-something thousand with Tradeify in 3 weeks. So I'll probably be moved to live in a month or two. And yeah, so that's it. But you guys see that, and you guys can watch me trade every single day. You see the difference between this kind of market and this kind of market. This is the difference between liquidity and illiquidity. Liquid markets are nice and tight and stable. Look, nice and tight. Even the news is really mild. Market responds very mild to news. But you guys can all see the difference between like this side and this side, right? The market over responds to news for these 2 months. Well, these are the 2 months that the community traders were also showing large periods of illiquidity. And this is where the market was liquid before. The alligator mouth was open and closing. So leading up into the choppy 2 months, you can see right here, longs are longing harder, shorts are shorting harder. It's fanning up like that. And right about here is when it started changing direction, and that volatility came out of here when everybody was selling and nobody was buying. Now, this last report update that we got, the new one will come out very soon. The shorts squeezed a little bit. Now, again, this is a week-old data, so it's not really actionable for now. But what you want to see is the story being told. It's not in the clear yet. The two sides of liquidity aren't there, but our Rocket Scooter's monthly map will tell you the liquidity faster than this. It updates every day. So because this is a week-old data, I kind of know what's going on right now. We are at the high, and the green is sort of ticking flat, and the blue is sort of ticking up. So it is started upticking as far as the last 2 weeks. And the last 2 weeks have started to feel a little bit better in trading, right? The news has become less choppy. Remember the tariffs crashed the market and it's less crashy. And then CPI crashed the market and it was less crashy. And then PPI crashed the market, but it was even less crashy. Like the CPI was big, PPI was smaller. You know, Fed was really big, tariff was big, and the market was like less and less and less and less and less responsive to news. Okay. So the liquidity has been coming back and the volatility has been drying up. So the last 2 weeks have been kind of that clean trading again, away from that monstrous volatility, right? And that's why we're trying to see as well. I wish I had like a daily update in commitment to traders. That'd be lovely, right? Wouldn't you guys love, I mean, tell me, be honest. Would you love for this chart to update every day? Would you like that? Would that make you happy? Damn government commission comes in here and updates it once a week, and then you're getting a data point for week-old stuff, right? Would you like a commitment to traders every single day? I know I would. Well, I made you one. I built one, a better one, using options positions. I update it every single day. It's called Monthly Maps, and it was inspired by the commitment to traders. Can I use positional data to find liquidity? That's it. So I buy a very expensive data feed from Opera, the options reporting authority that collects options data. Here's the best part. Opera requires people in options. So let me give you a little principle of the market, right? Let's use S&P as an example, or NASDAQ, same thing. S&P is equal to some sum of the stocks, okay? And you have instruments like SPY that are tracking this particular thing. And the neat thing about options, apart from the CFTC requiring futures traders to bigger reportable positions to report once a week, Opera requires you to report once a day. Every day at the end of the day, you must report to Opera. And Opera collects everybody's options data in SPY as an example, which will equal the options risk in SPX, which will equal ES futures risk, same thing. But it's as everything's tracking everything, the risk is going to be relatively identically spread in multiple markets. You're not going to see the futures market is short and the equities market is long. That arbitrage will bring them together. The idea is that, can I use options, which we get once a day, to create a once a day commitment of traders? And you, in fact, you can. And the neat thing about it, to put an engineer to this to figure out how to do it, every day at the end of the day at 4:15 after the market closes, reportable entities must report their open options positions to Opera. And they collect all that data and they redistribute it once a night. You get something called open interest, right? It's a piece of information that's given to you. Your Thinkorswim or something might show the open interest for you. It never changes throughout the day. It's one print once a day because it's the download of everyone's positions at the end of the previous day. So we take that data and we map it out to find the risk. Now let me go, let's use SPY as an example. Oops. I broke Rocket Scooter, hang tight. I got to log back in here. Hold on one second. Don't go anywhere. I would love that you guys are tuning in today, man. This is great. Are y'all learning something? While y'all are chilling here, give me a second. I know market's closed today, but I live trade, plus I'm teaching you guys something. Y'all having a good time. I'm glad y'all are here. Come every day, though. You guys might get... Listen, I'm going to tell you, I'm just as rich as the next YouTuber. I'm just not that braggy about it, but I'm going to teach you guys stuff. Y'all want to be here? I'll teach y'all some stuff. I'm not the showboaty type, but trust me when I say, if you guys are learning something, we want y'all to stick around and hang out with us. Okay, so we have something called monthly map, and please show the monthly map. Will it? Maybe it won't show because the market's closed. No. Let's see if we get a print. Yeah, we won't get a print because the market's closed. Damn it. Okay, so let me see if I have an example of monthly map. Do you guys, can y'all throw me like an example picture in chat of like yesterday's monthly map? Since the stock market's closed, we calculate it once a day and we print the current map out because the stock market's closed. We don't have a data pool today, but anybody have a picture of monthly map from like yesterday or the day before from Discord? Let me scroll through and see if y'all printed it. For an example. That's the one downside of a holiday. Well, I'm glad to be here at the market's closed. I know for you guys, I mean, a bank holiday is only a holiday for traders. You guys also have to go about your day, go to your jobs, go to your work. So y'all are still wanting your normal routine. Get up and learn something about the market. Might as well do something. I'm glad to be here. I don't like taking days off. I like utilizing the time we have. Well, shit. Anybody here have a monthly map picture? I'm scrolling up to see if I posted one. A good one. Let's see if I can find one monthly maps picture. I just want to show you guys what it looks like. Man, y'all talk a lot in chat. Okay, let me see if let me get one from my Twitter then. I know I post them all the time. All right. That's too small of one. Let me go up to here. Okay, here's a good one. So what it actually does is it's a community trader sort of thing, kind of in the same way, right? You're looking at slopes of things to try to determine liquidity, illiquidity. Grabbing it from the class, JK. Okay, cool, bud. So there's an example of a bear market, but basically what it is like, we created something called liquidity maps, which uses options to find liquidity. Very, very easy example. If you were to long the market against a dealer that shorted and they went out and bought calls against you, that call area is where the dealers neutralize. Exactly where they traded against you, they're neutralized at that one point. If those calls go in the money, dealers are going to be forced to long to balance their position. And so with the call sellers, they'd be forced to long because the risk of having that call go in the money, they're up for 100 shares per call if they don't have the shares in their pocket. So long markets create additional longing, just like short markets create additional shorting because option sellers have to chase the trend. Okay, so what we do is we look at each expiration. This is SPY at some random point in time. And this exact point in time right here, you can see something interesting. And what's neat about this is just trust me on this little layout here. You're looking at where the bulls and bears are positioned. And the easiest way to describe it without going into like a really large lecture about the liquidity maps, trust me, in our class, we teach this. The dark gray is where the bulls are more in control than the bears for the options world. And the light gray is where the bears are more in control of the bulls. And so we can like daisy chain every single options expiration together. This is 23rd of October, 24th, 25th, 26th. These are options that expire on those particular days, but it's not all options. So what our algorithm does is we grab all the opera data that comes in. I have a whole army of server computers that grab the data and crunch it. We look for zero risk tandem trades of this one particular trade and some others like it, but this is like the main one that we look for. And so we look for somebody that had longed a large amount of shares of something like SPY, for example, or S&P, right? So the long SPY. And there wasn't really like a good seller on the other side of that long. And we saw like evidence of mobilization of liquidity, like a market maker would step in. And then we see an equivalent options trade over in the options market, meaning that you longed when there wasn't a seller. So the dealer had to go in there and short to you. And they didn't want to short, have risk. So they went and bought a call. They went hedged somewhere else. We look for these hedge trades where the market has a neutral, right? One goes down, one goes up trade. And what we do is we say, aha, we found one. This is the one. So we grab those calls and our program like looks at all the options trades and then just highlights ones that belong to that liquidity guarantee, right? This is likely a liquidity provider who will be neutralizing their trade. The idea that they will be neutralizing their trade should be a key to you, that they will be longing or will be shorting the market to balance this position. And the sellers of those calls will be longing if the calls go in the money because they have to. And so because they have to are words you have to remember. Because they have to means they have to sell, they have to buy, or else they lose their neutral position. And so force hand buying and selling is the trick to what we do. You can use the options math to detect this. I mean, it's differential equations. If you're a mathematician like myself, it's not hard to do. For you guys, it's a nightmare to try to think that you're going to put in some math to your trading, so don't. We kind of do it for you and make it a little easier to understand. Okay, so one thing to note is that the bottom of these dark gray is what's called a bull zone. It's where there's more calls in the money than puts in the money held by dealers. And so call zone is, you can think of it like this. I'll just put call or bull. Is where there's actual longs in the market against the house. And these are dealer options that are found. And this is the put or the bear zone. And there's more puts than calls against a dealer as well. And we split it into two different camps. So this is actual traders where traders are short on their exposure. And this is where actual traders are long their exposure. And the space between them is the liquid spot of the market. As you see in this particular case, the liquid spot of the market is getting wider as time goes by. That means the market is expecting to become more volatile as these weeks go by. The positions just show that. And so the neat thing about this is, how do the bulls change over time? Where are they wanting to be the most bullish at? Well, at the bottom. So if the market, as time goes by, there are no bulls at current price, which means bulls are becoming less bullish over time. Over this 2-week period, each one of these is a day, there's less and less and less and less calls in the money. So less and less and less sellers of those calls buying the market, less long pressure. So when this bottom of this gray zone goes up, bulls are actually exiting their position. As calls expire worthless, then you longing because you sold the calls, you don't need to be in that long anymore. Once your calls expired, you're going to dump the long. Because you're going to dump the long, you're exiting your position. And what is a bull that dumps a long called? A not bull, right? So this is a period of creating not bulls, of people that were long and now are going to dump the long. They were long because it was wrapped up in a hedge that just expired. So if the dark gray bottom is sloping up like this, then bulls are exiting position. And we give you this cheat sheet as well to read this monthly map. And this is a daily update instead of a weekly update. If the bears sloping down, then bears are exiting position as well. So the market is less and less put in the money, same thing. And so this is a period of growing illiquidity as everybody's exiting position. Now, they're exiting positions at the same rate. Remember, the alligator is not super illiquid. It's just a choppier liquidity when it's like this. So when markets are doing this, it's liquid in general. But in the case of commitment traders, when longs are selling and shorts are covering, the not bulls and the not bears find each other, it's still liquid. It's just less liquid than this when everybody's applying bets to the market. They're both liquid, but this is actually greater than liquid too. This is much more liquidity, because as people are propping the market up with money, betting on both sides, then there's just more people in the game, so more traders to take action. When people are exiting the market and going to cash, there's fewer traders in the game, even though the act of selling and buying to each other is creating liquidity. So the alligator mouth on both sides is liquid, but this one is certainly more liquid than this one. So this particular, our map is the opposite. When things are fanning out, is the same thing as things are pinching together in commitment traders, because of the way options work. So this on our map is the same thing as this on the COT. It's less liquid than as liquid it can be, but buyers and sellers are finding each other. And then in October of wherever this was, what day was this? October 2023. The market was liquid. It's kind of balanced. And in October 2023, let's go look at it. Right? This is actually here. When the market was actually volatile, it was down in here. And then liquidity, that's why I remember this tweet came from here. The market had been selling for an entire month, and then we saw that brush of liquidity. And down inside of here, it started to stabilize as everybody, there was a lot of people exiting the market, but people were covering shorts at the same time. And then that tightened up that volatility, and then the market got liquid again. That's where that tweet came from. That was right down in here that we had that inflection point in the market. So when we detected liquidity, which is what that's telling you, then the market stopped crashing. That's why that's important. We have our updates like once a day. So let me see if somebody posted something in chat. Did y'all post it anywhere? Like a present one? So what a neat bull market looks like. Let me see if I can find you a good one. Here it is. October, so this is July of this year. Okay. And let me see that. June of this year. Okay. In June of this year, let me just allow you to see what June was looking like this year. June of this year. Okay. Here. June of this year, right? Markets, rallying, breaking highs, selling off, and people are like, it's got to sell. This is bearish. We're at the top. And, right, so people were like getting upset. I think it was somewhere in here. So June was here. Yeah, right when we broke double top, people were like, it's going to double top and crash. And this tweet came from me saying, no, it's still going to rally. And at this particular point in time, you can see the same thing. Because one thing you'll understand about liquidity is that positions don't lie. Candles lie all the time. Positions don't lie. You were talking about it on my channel last week. Well, we're glad to have you here, man. We love that you guys are here. All right, let me show you this, right? If this is the current price and calls are becoming deeper and deeper and deeper in the money as time goes by, if price were to stay flat here, on this week, you only had 530 calls that were in the money. Everything else, it was more puts than calls. But down, but 4 weeks later, 509s are in the money. You've got new bulls at half the long the closer you get to this expiration. These people, the calls are in the money, they got to buy 100 shares sometime between here and here. So when the bull side is sloping down like this, you can guarantee that more longs will have to long, because somebody that sold a call at 509 on this day is those calls are in the money, right? And so sometime between now and then, they have to buy 100 shares. And as time goes by, and they haven't done it, the likelihood they go up is even more. So the best way to think of this is like, if the market was trading right here and your puts are in the money, puts in the money, puts in the money, then all of a sudden this week calls are magically in the money that weren't in the money before. Okay. As you're approaching the expiration, people are going to be forced to long, which is going to push the market up even higher, which is going to force more calls in the money, more calls in the money, more calls in the money. And so the idea is basically that. It's the opposite of what we showed in the last one, is that when the bull side is sloping down further, bulls are longing more as time goes by. More bulls are entering the picture. It's the same thing as the Commitment of Traders report. We talked about more bulls are longing. It's when the green line is sloping up. So when the bottom of these grays are sloping down, more calls are in the money, which means more people have to long, which is that our monthly map is forecasting the Commitment of Traders 3 months in advance, because we can look at options that far in advance. I can now predict 3 months in advance on the Commitment of Traders by looking at options, because options, again, don't lie. I could tell you, are we liquid for the next 3 months? That's the power of what we do here. I'm not only reading the last month or two of the delayed Commitment of Traders, I'm forecasting the next 3 months of it by using options and SPY. It's a whole revolutionary thing. And like I said, when I teach this class to people, there are people out there that teach trading webinars and seminars that have asked me as a matter of fact, I'm part of a mastermind right now. Paper Gains, if you guys know him, they're doing this 1 month long mastermind course. And this is one of the courses. It's going to be part of one of the courses, a small part of it. But these kind of things are things that I've taught people, and then they ask me if they can teach people. Can I teach your work to people? This is something people don't understand, and it's because it's not an actionable chart. It's showing the history, and it's a week-old data. But imagine using options to see, are we going to be more liquid or less liquid as time goes by? Every morning we get a new read on the map, and we can forecast. And right now, guys, this is what we're forecasting. At the highs right now, our monthly map is telling you that liquidity is back, baby. What's the difference between rock scare and spot gamma? Spot gamma is an infant stage of gamma analysis. It's the basic gamma analysis. With spot gamma and other, they're not bad, but they're like the infant stage. They just kind of started. Now they've been around for a while, but they haven't evolved their process much. The difference is that a spot gamma would take, and they're good. I'm not knocking them at all. We're just so much different and so much better. The differences lie in this. Spot gamma, I'll tell you exactly how to do what they do. You don't even need to buy their service. They take the open interest and they multiply it by the different Greeks, the gammas, the deltas, the thetas, the rhos, whatever. Okay. And they just create a spectrum of exposure, and it looks kind of like this, right? And it kind of is like making inference as well, because there's open interest here and gamma exposure here. There's going to be something. The difference between their chart and our chart is our chart looks like this. We give you one spot, one pivot. That's it. We balance the market between bull and bear zone and make it actionable. Because what we do that's different than them is we don't use the OI. We take all of the OI, as I said, like, remember, every trade that comes through, our algorithm grabs one and says, aha, that's one to use. And then another trade goes, aha, that one's used. We only find the ones that we believe belong to dealers that'll have forced buying and selling. And we only find neutral traded options that are traded in a neutral position. That's the difference between us. Spot gamma will use all the options as if they're worth something. So somebody that goes out there and buys, I don't know, 1,200 calls in Tesla that expire next week. Clearly, they'll expire worthless, right? But what I call an open interest heat map, which is what spot gamma is, it's a basic version of what we do. You'll have a big skewed data point off to the right, way out of the money, and it's somehow going to skew your analysis like you think that it's important. Our algorithm would say that's not even important. We wouldn't even consider it as part of the calculation because the chance of it expiring worthless is 0. It's 100%, so we don't use it. So our algorithm plucks out options that belong to tandem trades only, such that we can predict that people will have to long against those options because they're trying to balance the neutral. You can calculate the amount of longing needed by solving Black-Scholes equation. And so the Greeks tell you how much people need to long every incremental change in the underlying. And a spot gamma uses every option with equal importance. And that's where that's wrong because there's no actionability. And as good as it is, and any gamma exposure model, as good as it is, will show you like, here's some exposure, but it's all exposure. How many times have you gone on there and bought like, SPY calls and you decide to go out there and hedge them? Pretty much never, right? You own a call. And if I were to use your call to make a decision as a trader, he has a call there, let me long there because you're also going to long there, but you're not out there hedging against your call. You just bought it to gamble. And so by that type of analysis, I can't prove that anybody I can't prove that you're going to go out there and act further on the trade that you bought. But if you were a market maker and that call goes in the money and you sold that call, you're forced to long. I can predict that because you're a market maker. Your job is to balance your trade out because you get paid to be in the market. So you want to be neutral. So we look at the neutral trades only, which basically means I can find where people are forced to buy and sell. And with that particular thing, I can create pivots that allow me just to see the one balance point. There's only one every day. And that's it. Now, today I showed you this one when I was trading futures and NASDAQ. I bought at one of those balance points. This blue line on my chart that I show you guys is actually the gamma exposure maximum of market makers only on weekly options. This is what this blue line is. And a long story short, if I'm going to tell you why I bought the dip here and why I made $3,000 in the 20 minutes you watched me do it, is because dealers are gamma positive here and gamma negative here on weekly options. That means right here, there's just a little bit more longing than shorting to balance neutral trades. And so as the market is falling and falling and falling, what did you see me do? Well, I went to the news to see, is there any news going on? No, there's nothing. Our market's closed. Nothing's happening. That's weird. It's falling. Okay. Market's just illiquid and volatile. And it's falling to a point where there's maximum amount of delta hedging. See, what we can tell you is the maximum amount of delta hedging takes place here. Here's the proof of that. There's the volume. And so when it fell and fell and fell and I had no evidence that there was any reason to fall, I just longed at the dip because I long at the side where the seesaw is tilted in favor of the dealers, longing more than they're shorting. I went to check the news. And so I provide one weekly number and one monthly number on monthly options. That's it. I don't give you like a noisy spectrum of data. And so what's good about like, not to take away from the OGs, Spot Gamma started, one of the first retail sides in the gamma exposure world. But as you use programs like that, you start to find out that there's no actionability to it. It doesn't give you an actionable point. It just gives you a little bit extra information that I would argue is not really useful at all. So nobody in the world has created an algorithm like we have that can actually expose dealer neutral risk options like we do. We have a very sophisticated approach to do so, and it requires a whole army of computers to filter all the options out to just the ones that matter. So every other gamma exposure that talks about it, dealer this and that, it's all bogus. They're not dealer anything. Dealer requires you to filter out which options are dealer. All of them use all the options multiplied by the Greeks to try to find some inference in the market. And what you end up with is a noisy little chart that looks like this. There's no way you can trade off of that. We give you something that looks like this and like this because we find where is the market balance between short and long. And that's it. And that's why they're split into two camps. And that's why the monthly maps come in super clean like they do. This particular picture, ours is so clean that look at our points. It's a literally clear bull and bear divide. Here's the bull side and here's the bear side. Bull, bear, market maker. We divide it into the three camps. So that's how sophisticated we are. Our sophistication is leagues above the next level. They're the giants. They're the shoulders we stood on to build something bigger. If you remember that Isaac Newton quote or whatever. So we built upon the gamma exposure world to create something that's actionable, to be a little different. Zero gamma is naive, is always the best guess. That's exactly right. As analytical market theory stated, is like the gamma exposure models are not necessarily proving that anybody's going to act on those options. But if we can isolate an option that we believe is belong to zero risk, then we can assume that a seller is going to long against that option when it goes in the money, because they have to. And so the forced hand longing and selling, which our market is good at, our program is good at doing, creates just a split. Here's the bulls, here's the bears, that's it. And really as a trader, that's what you want to know. Are the bulls becoming more bullish over time? Yes. Are the bears becoming less bearish over time? Yes. Over this amount of time. And when sloping down, bears are exiting. When sloping down, bulls are longing. So shorts are covering, longs are buying. It's a double long pressure in June of 2022, right? And or 2024. And when I show you this in June of 2024, that market was all short squeeze and long buying. And you see from that accelerating curvature to the upside, that's your short squeeze of the bears exiting position. And then the bulls also buying is grabbing every dip to also long. So you had a nice clean liquid rally to follow. So when our lines are both sloping down, everybody's buying. And from this point in time, the market just went up. So positions don't lie. And that's the whole point of what we want to try to do here, is do that. So now why did I make the trade I made today? Well, I read the monthly maps every day. I know the market's liquid as hell. Commitment Traders also shows growing possible liquidity this last print. Our monthly map has been bullish for the last 10 days. So or liquid for the last 10 days. So because the market has shown liquidity growing in the last 10 days, you can see that the volatility is becoming less over the last 10 days. And again, you can see that the daily range of the market is becoming less and less and less and less, and then nice and tight. About 10 days ago, our liquidity maps started to slope down to show liquidity was starting to appear right here. And every single day going forward, the market was less and less and less and less volatile. Tariffs were huge. CPI was less huge. PPI was less huge. And PPI was the worst number of all of them. It's the one that actually came in bearish. Prices were through the roof. CPI was just barely a miss. CPI was 3 on a 2.9 estimate, and all it did was push the Fed's first rate cut out until December from January. Market fucking hated that news, right? And it dipped, it came right back because it's not really a big change. The PPI showed that prices were going through the roof. These were huge misses, and the market didn't even care because liquidity doesn't lie. People want to buy for whatever reason they want to buy, and their positions are going to show you that. You may see the worst news of all was the lease dip. You guys remember PPI was a nightmare. I was worried that morning. It was here, right? It was this day. And the market literally did this. That was the PPI. This was the most bearish of all the news. Well, besides the tariffs. One may argue tariffs are bullish long haul, bearish short term. But either case, the market was liquid forming, and we had the evidence many weeks ago. So liquidity analysis is very important when you're actually looking at positions. I hate when people teach liquidity analysis looking at candles. This is not liquidity analysis. Candles don't show liquidity. The lack of volatility can imply liquidity, but you're only observing as it happens. In a rocket scooter, our posts back in here were like, market's liquid again. We're not crashing. And all over my Twitter, it's all over there. I post them all over the place. And once a day, we print out that report for you guys. So if y'all are tuning in, y'all like this, feel free to sub to the channel. I live stream every single morning. Like if you're just tuning in, let me find on my Twitter. I'm a live streaming trader. I've been trading on YouTube since 2016. Very profitable trader. My average win rate's roughly 80%, and that's not a lie. I don't trade a lot. This is the profit I made today. I post my results every single day. This was my net P&L for my first 3 weeks with Tradeify. I just decided to check them out. They're about to have a futures trading contest in March. I'm going to compete in it. This was me in 3 weeks with the first time I've used these guys. This is straight to funded. About 50K with 83%. I tweet everything I do. I'm fully transparent. You can watch all my trades. I don't really do anything but post what I do. I'm a huge math nerd. I took my Christmas tree down on Valentine's Day. If you judge me, I hate you. People come to me as like the mathematician of the market and ask me math questions and stuff. I tend to just always be the voice of reason when it comes to like the math. People are like, is this cool? Is this true? Is this not true? Because people know I usually take an unbiased approach and just like come in and look at the market on its merits of just math. I try to be very much by the book. Ah, here we go. Aha. February 6th. Let's go ahead and go up here and do the I told you so. Let me see if you guys know this. Hold on. Let's go do the I told you so. As much as you learned today, let me quote. Come on. You know, called it. Watch this. And guys, you're going to learn how to do this. Called it. Oops. Okay. So let me dissect this tweet for you guys so y'all can see it. Does any of this stuff mean anything to you? February 6th was the date of this post, okay? I don't know which day that is on here. Aha, February 6th. Aha, right here. Right here. All right. One may argue that this is a bear market forming. You took your Christmas tree down on Valentine's Day. Mike, we're like best friends, dude. If that's the case, we're buddies for life. 80% win rate. Can't fake that. And it's because I'm very specific when I trade. I'm not always in a trade. I have a very specific conditions when I line up, I attack. I spend 90% of my time sitting out. It's great. I think you could sit out as a strategy to make money. That's what we teach you here. Avoidance when not necessary. Okay, so one may argue in the mix of all of this, you guys are pretty scared, right? 3 days prior, the market collapsed on like tariff news. You guys remember this? Y'all remember this, right? How many of you were so, now again, you guys in here might be, but if you're not from here, how many of you were uncertain here? And it's okay if you were, because a lot of people were. Don't be shy. In this, after the Trump market or Trump tariff stuff crashed the market, right? At this point in time, were you guys like, I'm about to go all in long bullish this market from here? Or were you like, I think I'm going to wait it out? Yo, yeah, Adrian, bro, dude, you got it. Tradeify is straight to funding. If you use our code, it'll make it 30% off. But you can skip the evals, dude, and go straight to funded. They have a 20% consistency, which sucks, and a 10-day trade period. But as long as you keep your wins fixed, it's like one of the better things. It's the end of the day drawdown, which is even better. They cost like 500 something per account for each 150. I think I paid like 2,500 for these 5 accounts, but I already 10x'd my money, or sorry, 20x'd my money. Yeah. So you guys were like, kind of like, probably like, shit, this market sucks, right? And a lot of us were like, a lot of people were like, man, Trump's going to crash the market. Things are bad. But on February 6th is where I'm circling when I made the tweet, which was here, there. Now, that's the only tweet I have. I know I was tweeting before that because I remember we were talking about it before it. But I was just kind of like trying to remind the market. Now, let me decode the stuff I told you guys. You know, I'll make it up as I go along. Everything I taught you, you can basically translate exactly from here. Today's monthly maps and rocket scooters show a stabilizing SPY into very bullish. Very bullish. The bulls are becoming more bullish. On the committed traders, the longs are likely to add to their long position over time. QQQ is not looking so good, but not terrible. I trust the SPY of QQQ for overall market sentiment. Options are a telltale sign of people's intent to buy and sell and are the true reveal of any market structure. Bulls are bulling harder. Bears are covering shorts. When both are sloping down in our world, it's a short squeeze. And from February 6th onward, we've experienced an illiquid short squeeze, which propagated the market higher. From here, a lot of people saw this top and probably tried to short this market, whereas I was buying at the high and buying at the dip 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 and buying at the dip. And every CPI dip, I bought the dip. PPI bought the dip, because everybody's buying. The options market doesn't lie about that. And the neat thing about that is that was determined back here. When we decided to show a point of short squeezing, We determine it right here, which means every big major cover, people are going to get out of short. Now I can see a short squeeze on a candle chart. It moves like this and it curves up. A long event on news is going to move like this. And the news creates an event that slows down the buying over time. A short squeeze stacks upon itself as shorts push cover and push the market even higher, and call sellers are forced to buy, which pushes the market even higher and higher and higher, and it goes higher on its own merits of people squeezing others. So back when this market kind of like covered here, can you see something neat about how the market kind of moved each time it dipped? This is this was selling off on catalyst. And you can see on this event, the market moved like this, right? So people were covering longs on news or getting out of the way, which is a news-based event. It curves this way. But people getting out of shorts, right? One can see that the market moves rapidly this way. This is a short squeeze. And as it dipped, you can see there's like these J-shaped moves that are bigger on the upside than they are on the downside. That J-shaped move is short covering. And we told you they were short covering through this monthly maps tool that we have. Every morning at 9:30, it prints a new read of the market. It's beautiful how it works. And you see how all these upward propagating moves were short covering. There's almost like a clear night and day difference between this day and this day. Even the big gap down covered short. Even this market started to speed up and speed up and speed up and speed up and speed up. Welcome to the world of short covering. That's what monthly maps are telling you. That people that are short are getting out of the way. Every dip it finds, they're going to get out of the way. So the market became more and more responsive towards the upside. Every dip got bought up. And look at this short covering. Short covering. It's so neat how that works. The market hasn't really amplified up on a good bull rally as of late. It's just inching forward, but the shorts are covering. And now the market is moving on bullishness. You can see the difference. It's not a J-shaped move. It is a straight move with no volatility. This is a genuine bull run. No volatility. No volatility. Bulls are buying. Bulls are buying. Every single dip you have, shorts are still covering. Dip you have, shorts are still covering. And the bulls can't get in any faster. This market is not completely nice and illiquid, right? I'm sorry, nice and liquid. And because of that, the VIX should be in decay, which it is. Since the 6th, that's what my tweet was about. The VIX was going to be in decay. And since the 6th, I forecasted that right. Despite the couple of news events, the VIX has been in decay ever since, which is what we're talking about. So the idea is you can use positions to make a greater understanding of the market, and that's kind of what we do here at Rocket Scooter. I'm an engineer, and our Sears engineering thing. Hey, you won last Friday ETF contest? Can someone help you in Discord? Yeah, I got you. I'll get you your things today. Prediction using the crocodile mouth for NASDAQ. Yeah, so let's look at the NASDAQ here. We don't have our monthly maps data today because the stock market's closed. Unfortunately, we don't have it. But we'll have it tomorrow morning. So come front and center. I'll give you guys the read tomorrow. Y'all cool with that? I'm glad you guys tune in. I love teaching, man. We have so much fun with this. Last but not least, yeah, let's look at NASDAQ futures, right? So now, be warned. You're going to find a greater understanding of the whole stock market by looking at the S&P and not the NASDAQ. The NASDAQ has its own independent movement, but the S&P is really where you want to be doing this kind of analysis. On the NASDAQ particular sense, the NASDAQ was the source of most of the illiquidity as stocks like NVIDIA and others were carrying the market down. NASDAQ has been sloping down on both sides, which is why our monthly maps on NASDAQ were actually worse than the S&P monthly map. And my tweet was actually showing that too. Remember my tweet was like, QQQ is not so great, but S&P looks fine, which is typically what you lean towards. If the S&P is fine, the market's going to be fine. If NASDAQ is bad and the S&P is fine, then people are just rotating into other sectors that aren't part of the NASDAQ, like financials or energies or something. So NASDAQ was in a really bad state while the S&P was kind of in a medium bad state. NASDAQ was like the scary part. We're like, okay, tech's crashing. That's the problem. And that's what actually caused this volatility more than anything, was a lot of the NASDAQ stocks were extremely illiquid and everybody was selling. But over the last 2 weeks, you see that the blue and green are both sloping up, which means short squeeze. Longs are longing harder and shorts are covering. It's an illiquid move to the upside, which implies a short squeeze that's fueling the market with the genuine bull buying, which is why in the NASDAQ site, it's got those J-shaped moves that are moving even faster. NASDAQ was where the big runs are. Look how crazy NASDAQ was. And again, it looks similar to the S&P, but but the Nasdaq was really getting most of the breaks. I mean, Nasdaq was like the one that was like crushing through these DD bands and stuff, and S&P wasn't as brutal, but Nasdaq was the most illiquid of the two. I mean, it was just like really nuts when it was happening. And so, but you can see that as of lately, all things are pointing up on Nasdaq, and you can see that volatility is completely dried up on Nasdaq. It's funny as it sounds. The $3,000 I made was buying this dip right there on Nasdaq, of all things, because the liquidity is there. I don't expect this to be any more volatile than that, as liquidity is present and volatility is drying up. Right? I use this for my information. So every morning, you guys have to understand, I have a very quick thing I do. It only takes like 1 minute. I have 4 indicators that I look at, and they're all from Rocket Scooter. Number 1 is the CD ratio, which talks about stocks being in bull markets. This looks for today. Like, we look at today's analysis to see what the stocks are doing. And I trade only futures, by the way. We use the monthly gamma exposure of market makers called MHP to kind of look at what the current options month looks like. So about a month out or max to get the greater exposure of the market. We call it greater market. And the last part of this, like I told you earlier today, at the start of this was monthly maps. Monthly maps looks 3 months into advance and tries to forecast the same relative risk positional landscape in the community of traders. Tries to forecast 3 months out. So I use all of these to determine if I'm a bull or bear. And as of 2 weeks ago, all 3 of these things were pretty much pointing up, if not one of them was flat. We broke MHP maybe one time. DD ratio was less than half one time. But when all of these 3 indicators I look at, if any one of them is bullish, I'm still bullish this market. There's only one period of time when all 3 of them, or 2 periods of time this year when all 3 of them were bearish, and that was in December and once in January. So I've basically been bullish even through this whole last 2 months. I've been buying dips and buying dips and buying dips. As a matter of fact, in this Tradeify account that I keep showing you guys, the one that was up, whatever. Let me get the picture really quick. Let me update this journal here. I don't think I've shorted one time. Maybe once, if anything. Go here. All right, so let me take the picture. This does include today's trades. This is my net P&L with these guys, and almost all of these trades were long. And this is through December and through January, February, end of January, beginning of February. I've only longed since I started with these guys. This is how much I'm up in the 3 weeks. So now I'm at about 84%, counting today's wins. I pretty much long the market most of the time. About 90% of my trades are long. About 90% of my day is waiting. Most of my trades take place without 5 or 10 minutes worth of work, 30 minutes max. I make like 1 or 2 trades a day, and that's it. I minimize my exposure to lightning strikes and catalysts by being out of the market most of the time. And I only side with the greater bull market. I spent all morning teaching about the monthly maps. That's one of 20 classes we teach in our boot camp. My boot camp is 20 classes just like this one. If this was relevant and interesting to you, we invite you guys to take our full boot camp. It costs $1,000. No, I'm just kidding. It's a fucking dollar a class. It's $1. We do this because I'm a very, very well-off trader and I don't need to sell courses for a living. I want to teach you guys for free. I just spend my YouTube trading though. I don't actually spend YouTube teaching. This is a one-off because it's a holiday. But if you guys are interested in learning the other 19 classes that are just as potent as this was like a class. That's the link, and it's $20, and that just pays for the girl that makes the little handouts for y'all. That's her salary. The boot camp is $20 deal. That's it. That's literally it. It's 20 days, 20 classes. We start on Tuesday. We go through all 20 classes. They're not just this. They're classes on position management, risk management. They are skill-based classes about trading. 0% of the classes are technical analysis. 0% of the classes are chart reading, candle analysis, time frame analysis. Zero. It is all betting principles. How to bet, where to stop, how much to bet, how to size your account properly, how to maintain proper risk to reward ratio, things like that. It's a master class on betting. Picking direction, finding the trend, and betting. The 3 principles we teach in this boot camp are as follows. And then, this happens all the time when our members who took the boot camp are now donating a class. All right, you guys. I love it. They do these all the time. Okay. Y'all are so crazy. All right, let's do it. All right. So somebody's about to get a free boot camp. So let's go here really quick. Somebody, K-Specs taking the class, and he says you need to also. He bought it for you. So one of you guys got really lucky here. Hold on. The members are like screaming at you to come to the class. This community and this thing that I talk about, what we do here, it might sound really neat and like, okay, yeah, this guy Matt does all this stuff. But let me tell you something cool about Rocket Security. It's a community-driven thing. I'm just the leader here. There are hundreds of contributors to our studies and our tools. It's a group of people that come together and volunteer to make stuff and do studies. Our own members are the ones that do the back tests. We've created 80%, 90%, 70% setups, and it reflects in my own win rate. Yeah, so the class is literally $20. We go from class 1 to class 20. We get to the end and we start all over. The very first class, I teach you a hypothetical thought experiment on betting. At the very first class, I give you a guaranteed winning strategy on paper. It's a hypothetical strategy that actually proves that randomly longing the market by managing your position size is actually a winning strategy. I mean, we prove it, and we build off of that framework in the 20 classes, and we go all the way to the end at 20, and we start over and repeat. And it's the most popular thing we've ever done. It utilizes our platform with all the information, but you don't have to have the platform to use the classes. And we teach you that the main principles of what you're doing wrong, and I want you guys to understand, these are the 3 things you guys are probably doing wrong, and it's okay because we've all been here. Number 1 is you have a horrible way to identify the trend. How many people here, the market goes up, you feel uncomfortable, oh, I kind of want to short it, right? You're feeling like, it's kind of wobbly, maybe I should short it for it to crash. You're trying to fade the market or reverse the market too much. You're not trusting the trend. So we teach you how to identify the trend most likely. And people say that this is like Matt's stop shorting class. As most people go through our classes, they get to the end and realize they're pushing the short button too much when the market is mostly bullish most of the time. Right here, I'm looking for dips to buy. I was laying for a dip all night. I was like, man, I can't wait for it to go to blue so I can buy the dip. Why? Well, because monthly maps are bullish, the things I taught you this morning. And our 2 other indicators are also bullish. Everything's bullish right now. So I'm just waiting for dips to buy. I'm not trying to fade the market. So we teach you how to identify an actual trend using positional risk. This is the key part of that. Get in on the trend. Markets don't change direction that much. Market is chopping and not so volatile and very liquid inside of a nice little tight range. So I'm thinking like, the market's probably going to be tight in this range because it's very liquid, right? So I think of things like that. So we teach you how to identify the actual trends so that you can decide what the proper side of the market is. And once you do that, you'll realize that you're going to be a bull about 90% of the time. It's a weird shift for most people, but everybody that's taken the boot camp, have you, and again, I don't give trade ideas in my Discord. I'm the one Discord in the world that doesn't have a trade ideas channel either. We teach you and you're off on your own. It's really weird that we're probably the most successful trading Discord there is. It comes free if you have the platform, so it's even free entry. But I don't give trade ideas, and yet we have more successful, I think, traders in our Discord, I think, than I've seen any other Discord. I go to a lot of them. I'm not saying that there's no guarantee of success if you do anything we do. I'm very honest with you. Majority of people fail at trading. So I'm not going to say that these results at all mirror your results in legal sense. I'm going to be very honest. These are actual people doing. So people are posting their stuff all day long. There's people trading with Tradeify. Days traded. This guy, that's JK just got a payout from Tradeify. This guy's his first week trading with us. This is Benny Trades past 5 50K evals on Top Step. There's his Top Step. This is all last 3 days. Rob became a funded trader at Top Step 3 days ago. Like I said, this doesn't imply you guys are having any success here, but that you're going to be in a community of real traders doing real things. Master Rich, this is his Tradeify. Even transparent traders that really come in and show you when they when they kind of mess up. It's a really supportive community here of people that like support each other. Rich has been with us for a very long time. He's rocking some good win rate. Frank Underwood crushing it on Tradeify. Again, this goes back to like last week. So it's a huge community of traders sharing their trades, sharing their stuff, and they've all got them the boot camp. We have roughly 6,000 people in our Discord. And Discord is free if you use the platform. So it's not like a paid Discord service, but everyone learns trading, right? Okay. So if you sign up for the 20 days class, you need to go to your dashboard in My Communities and click claim, and it'll give you open access to the Discord. I'll show you how to do it in a second. So one thing is we teach you how to identify the trend. It's called the you shorting too much classes. The second thing is that we tell you that you're betting too big for the risk that you're taking. A lot of you guys are on the wrong side of the trade most of the time. Not doing number one gives you a low win rate. You're going to tuck closer to 50% by shorting and longing and shorting and longing and shorting and longing. If you pick one side and stick to it, whatever side you pick, I picked the long side mostly, and I only short under certain conditions, which is rare. Market doesn't really line up for a short setup that often. I long about 90% of the time. Once I did that, my win rate went from 60s to 80%. Even in bear markets, I long most of the time. I teach you why I do that. Even today, markets fall, I trustable pivot, I go. It's liquid enough. So your trend identification is your low win rate. How many of you guys trade and you make money and you make money and you make money and then you bust it out in one day? Let's hear it. How many of you guys do that? Pretty much, right? Y'all, that happens to us, right? LOL. People are like, why are you calling me out, dog? So this has to do with your betting too big, and it's you have a really bad betting philosophy. And this is why I hate trading education out there, because trading is teaching you like indicators and where to buy and where to sell. It's like a fraction of number one. That's it. Most trading courses are like chart reading, and they barely go into anything. The real art form of profitability. Now, you can have a high run rate and not be profitable. But to have a high profitability, you have to bet correctly. Most of our courses are on this topic, betting correctly, making sure that you're in control of your P&L rather than betting too big. This happened because you bet too big, straight down. You didn't have a stop loss in place. You didn't have a good risk plan. You bet too big for the risk you were taking. Your profitability is way off. You have a high win rate and then you lose it all in one trade. Well, that's number two. You're not betting right, and that's okay because it's like waking up from the Matrix. Remember Neo was like, oh, my eyes are hurting. Why? And they're like, well, because you've never used them before. And he's like, so it's okay. You've actually never been taught how to bet in the stock market properly. And so the boot camp is a masterclass on betting. It's the profitability portion. It's actually called the 20 Days Profitability Mindset Masterclass. It's a class on card counting in Vegas. It's kind of what it is for the market. And number three that we teach you is market avoidance. And a lot of people don't teach you this as well. How to avoid the market, when to sit out and why. We have a bunch of indicators that tell you sit out no matter what. Don't play in this. Volatility is abnormal. Catalyst is accelerating the market, things like this. Avoidance. This has to do with the random hits to your account. And I took a random hit. I took a big loss, one of two losses I had in this last month by being in the market in a random event. Gaza ceasefire news came out last week, like last Wednesday, and I was in a long at a really strong pivot, and the market just went against me. And I longed again at another pivot because I was trying to get to the payout window. And then again, it kept going, and then ultimately like made its way back. But I took a hit because of a random event, because I couldn't avoid it because it was a random news event. But there are things you can avoid and signs to avoid when markets crash. Unfortunately, sometimes you'll get zapped because of a random news event, but at least your big losses can hopefully be limited to that. Everything else you have control on. So the parts you have control need to be in full control. The parts you don't have control on, you need to pull the ripcord at the right time. So avoidance strategies is also missing for most trading educators, which is like their signals are always firing. Long here, short here, long here, short here. Our strategies are like, do we even trade today? We have a lineup of indicators that tell me to sit out. And I sit out on a lot of conditions, and I just wait. And the way this market avoidance strategy, it assists both of these at being better. It actually gives you a lot more control of the market, and fewer random events blow you up. It sucks when a random thing kills you. Nothing you could have done better but avoid the market. And that's kind of the crappy part, right? All right. Everybody type in the words free class. And our boot camp is 20 days teaching these perfect things here. Everyone type in the word free class. And we're going to have a raffle because somebody's going to get a free 20 days seat to the boot camp. Market avoidance strategies, betting strategies, and trend strategies. Free class. One word, one word, one word. If you're only not a member yet, somebody bought a free class for somebody. One word. I'm so glad most of y'all are coming to the boot camp because y'all can't even follow directions right now. I'm about to shape y'all's brains. Free class, one word. Free class, no space. Free class with 2 S's, Lonnie, you goofballs. The bot will only read free class, one word. Free class, baby. Kenny Kingfisher, add in extra words. The bot isn't going to listen to you. You got to put free class all one word. Free class, one word. Hold on. My YouTube froze again. There you go. There you go. There you go. YouTube has a way to like lock up sometimes. Okay. Hold on, you guys. There you go. While I'm waiting for YouTube to load back up, YouTube likes crashing a lot of the time, and I don't know why. Appreciate you guys coming here, by the way. We're live streaming every morning. If you get sick and tired of live streamers out there and about there, not really teaching you much, and most of this like they're gambling, and they're prop firm warriors playing prop firm arbitrage, and you don't know if they're winning or losing or whatever. And you want like a little bit more substance to your diet. We welcome you guys to come be part of our community every morning. I live trade every day, and we have a Zoom call every afternoon. And again, most of our stuff is extremely cheap, like these $1 classes, because it's really just to educate people. We'd like for you to use our platform, of course, as well. But, you know, we want to make sure that this education is affordable, right? I've seen trading boot camps, people with $5,000, $1,000 a seat and stuff. We're not like that here. Okay. All right. I'm going to spin the wheel. What the heck? We'll spin that wheel, baby. Okay. Y'all ready? All right. All right. Free class, one word. 5 minutes later, y'all are still getting it wrong. Thank God you're going to come here, and I'm going to teach you guys how to fall in line and follow directions. And my system is mechanical. Why not create an algo? I could. I very well could. It's been talked about. Free class, one word. FREECLASS. You got 30 seconds to type it in one time. I thought, Spike, I have thought about it, but as the years have gone by, I had to make the strategy more sophisticated to have. So some of the setups now are actually 90% probable under the most ideal conditions when everything lines up. My algo wouldn't be trying to trade all the time. It would only be trading like 80 and 90% setups, which are more rare, but they're the more profitable ones. And I thought about creating that and then having it trade on the side. Bootcamp's registered and can be found in the Discord. Yeah, they're recorded and in the Discord. If I made an algo from this, yeah, if I made an algo, guys, I would do bear zone top, bull zone bottom, and all three indices all day long. Bull zone bottom, DD less than DD greater than half. I do DD band taps at the bottom, my long only high probability setups. You guys know that the three I would trade. Bull zone bottoms, bear zone tops, DD bottoms, so DD ratio greater than half and no irrational signals. Oh, baby, you know that'd be money. I'd love to do that. And I just have this bot running on the side, scalp him a couple, $5,000 a day or something. Just when it lines up, take the trade. I'd love it. Our liquidity's not working today on the platform. Glenn Paris, the stock market is closed. So we won't get any read until tomorrow. All right. Free class, free class, free class, free class. Last 30 years, you became really awesome at taking your losses, world class, losing small. Scott's doing the work. That's kind of the point of like successful trading is about how to lose the right way. I tell people like, when you're working the carnival and you're like a trapeze artist, your job is to fall. But the art form is learning how to fall without breaking your neck. Everybody falls. You will fall all the time. But if you're basically learning how to not die when you fall. And if you do that, you can make a career as a trapeze artist. Anybody can swing on a thing, but not everybody can fall without dying. So you're kind of trying to learn how to do that. Okay, we're going to spin the wheel. If you cut your losers by 25%, your profit increases by 50%. Yeah. All right, spinning the wheel. Whoever gets their name called is going to get a free 20 days bootcamp. Okay, and we start on Tuesday, by the way. Toronto Trader. Aren't you already a member? Toronto? Only if you're not a member. I think you already have the class. Toronto, you got 30 seconds. Aren't you already a member, I thought? Toronto. 26 seconds. We have to spin the wheel again. I think the red line is called an illiquidity pivot. There's a whole class on it, Andy. It's another high volume pivot. Toronto Trader got up to take a piss. You got 10 seconds. I'm going to spin the wheel again, baby. All right. All right. One more time. They weren't here. Golden Rose, 30 seconds to say something in chat. 45 seconds. Just be like, yo, hey, I win. There you go. All right. Go to Discord. Go to Discord. I'll give you a link. Message one of our admins and say you won the class. We'll give you the code. Good job. That was donated to you. All right. So last week in our chat, there was like a gift-a-thon. We had like, what, 6 or 7 we gave out. People were all like paying $20 to buy you guys classes. The members of this community want you to join this community. This is what they're telling you. The members are part of the investigation and the creation of these tools and the discussions. We have these as groups all the time. We always talk about this stuff. And it's like a community-led thing. So it's kind of cool. Give a free one to Scott. Who's Scott? Hold on. Oh, and a free one to Scott. Okay, I'll give one to Scott, whoever Scott is. Did you gift the second one? Scott? Okay, yeah. All right, Scott, I'll give you I'll throw in $20 for yours. How about that? According to Kevin. Okay. All right. Scott, you too, on the house. That's for me. That's my gift to you. Okay, so the idea is that, you know, traders get duped and tricked a lot by buying stuff that's not necessarily helpful. If at minimum, our boot camp goes to 20 days, and after the end of the 20 days, we start all over and go through them again. Tuesday, we start tomorrow. Class number 1. Today's the last class. And then we start all over from number 1. So tomorrow is the time to jump in on it. And if you guys want to check it out, after 3 days, if you don't like it, we give you a refund. It's pretty simple. So $1 a class, that's it. I hear Pickle outside. I hear his little paws. That was a fun day today. I'm excited. I need to walk up to my next payout window with Tradeify, which is good. Let me see how far I am from this. Hold on. Oh shit. We got to guess. I knew it. I heard him.
You heard him?
I heard him. Hey, you lucked out. I made a trade today.
You did?
Yeah, I know you're worried. We took Pickle to the park yesterday and I missed. I have to make 10 winning trading days to meet the next payout window, and because the holiday removes a day, I had to make a trade on the holiday. And look, I got something. I had to count as a winning day. So.
How did you trade when the market's closed?
Futures market is open on holidays, half a day. So futures are a global thing. You trade around the world, and so President's Day is a U.S. thing. Oh, what's up, Pickle? Dude, his ears are looking like floppier and floppier. This is Pickle, by the way, you guys.
It looks like Batman. Like, you know the Batman symbol?
He kind of does, dude. He looks like a gremlin. If you guys, he looks like Mugwai. I don't know if you ever saw Gremlins. She was a 90s kid. Look at him. Here, come here. Come to daddy. You hate the lights. Wait. Whoa.
Hair.
Sorry.
You have to put glasses on him. Where's the sunnies?
He gets worried about the light. Come here, bud. Look.
You look so funny. He looks like you. With a longer snout.
Thanks. I love being called a dog. Here. Oh, he's nervous. Hey, buddy. Come on. Daddy, come on. Stand back. I'm gonna switch your toes.
Okay.
Biggle. Why you worried, buddy?
I wish we can show chat his tricks. His trading tricks.
Oh my god, this is Pickle. This is like Rock Scooter mascot here. He is an English cream dachshund. He is not wanting to be here right now.
He hates the light.
He hates the lights, yeah.
I came here for my games, not for you.
Oh, well, fine, whatever.
I'm just kidding.
What? No, don't even lie. She wanted to go play Hogwarts Legacy. Take your Switch and get out of here.
Hey, I love you that much where I brought Hogwarts Legacy into your office.
Yeah. Go get your Switch. Get the hell out of here. Hold on. Pickle's awesome, dude. He's like the best dog. He just doesn't like me as much as her, I guess, because I'm always working up here and he's always downstairs and following her around when she's working.
Did you tell them that we saw Pickle's future, the 5-year-old dachshund?
Oh yeah, it's as rare as English cream dachshunds are. It's a rare, like an English cream dachshund's a rare breed of a dachshund. They're hard to find. And then the cream colored ones are the rare breed of the rare breed. So you don't see them that often. We had a special breeder. We were on this huge wait list to get it. And we actually saw another one last night at the dog park. We took him to the big dog park in Houston at Eleanor Tinsley Park. And then, yeah, there was his old counterpart there. There was another version of him.
He was an asshole, though.
Yeah, he was kind of a mean dog.
They're known to be assholes.
Dachshunds are, they're mean as shit, yeah. Anyways, there's Pickle, you guys. All right. Okay, so we have a little bit more time here. Let's say bye to Pickle. He usually, when you're not here, he loves to sit here behind me while I like he sits in my chair.
He thinks you're too loud.
Bye. Bye, Pickle.
Guess I'll see you later. Come on, Pickle.
That's funny. She's in here trying to pretend like she wants to talk to me and talk to y'all. Chick's getting her Switch. She can go play Hogwarts Legacy. She don't care. She don't care about us. She brought in Pickle to bait me so she could interrupt my stream. Her intentions were revealed. I knew it. I should come in here like she come to get her Switch. I knew it because she put it on the other monitor. I was working on the stream last night and okay. He's growing pretty fast. He's 4 months old now. He's actually got like slightly bigger. But yeah, he's a good boy. They're really smart dogs too. He was very easy to potty train. I already trained him to ring the bell when he wants to go outside. There's some sleigh bells hanging on a rope, and he goes up there and he hits them with his nose so I can open the door. Yeah, super cute doggy. Yeah, it's fun. How long will I hold a trade before I decide it's not going to turn around? How much? So Brad, it's not time independent. It's all it's all price based. So essentially, one of the things we teach you guys here is how to identify high volume pivots. We utilize some of our tricks to find high volume pivots. If I showed you that I was using like commitment traders or anything else to forecast like liquidity points and things like this, this is a high volume pivot that is based on options as well in futures, 6136 S&P. And so if the market is above here approaching this pivot from the bottom, from the top, I always long every time. As a matter of fact, I have a cheat sheet that tells me I long every single time. It's very rare instance I would not buy this dip. In the cheat sheet, let me show it to you. In our Discord, we give you guys handouts. Like this is one we covered today, but we give you handouts on all these different setups. Here's the one of the trade I made today, the $3,000 trade. It's called dynamic hedge pressure. It's a particular type of forced hand longing based on options. You can see right here, it's not hard to see what you see on the chart based on this thing. Oops, right here, right? Let's move this off to the side. You can clearly see is mode 1. Open above both, which we open above both like the flashcard says. Here's 1, here's 2. I will long at the first blue. And I will also, if it dives down here, long at the second blue. Now my tricks are I long at the tail, close at the tip. So I go from here to here or here to next resistance, which is somewhere. I haven't showed you how to calculate next resistance, but it's there. So when I commit to a long, it's called commit to trade. I commit to risk versus reward. That's it. So in this trade, because the stock market is closed, I don't really have any indication the market's going to do anything. So I wasn't expecting it to do much. So when it did something, I longed to get it back to where it was going. After all, the greater market signal, all three of those things are bullish. Monthly maps are bullish. Market's liquid. There's no reason for it to sell off. I checked the news. There's no news. So I just bought it to go back to where it started. This is one of my normal trades. Whenever something happens on volatility, hits a high volume pivot, I trade it right back up to the liquid spot. Where the original sellers and the original buyers meet each other in the middle and keep going, we undo that volatility. So my target was basically from here to here. That was my next resistance. So when I commit to the trade, I literally don't, it's not how long do I hold the trade. I commit where I know there's going to be high volume, check. When the market holds the pivot and goes in the other way, I want to see volume in decline against a move to support the pivot, part 2, check. And then as the market keeps going like this, All I know is that the minute I commit to the trade, I know how much I'm going to make. I did it in NASDAQ. Let's pretend it's S&P. This is roughly 10 points to the upside. And the maximum risk I take for the S&P is 10 points of risk. So it's a 10 to 10 trade. It's roughly a 1-to-1 trade, which is okay. I take a lot of those actually because the probability is high. My normal max stop in the S&P is about 10 points. My max in NASDAQ is 40. So on this particular move in NASDAQ, I actually had a 40-point stop off of the base. So it's a commit. I either get the run or I get the risk, and that's it. It's never a how long do you hold for. I'll hold until I hit one or the other. So if that makes sense, so how much money? Yeah, full risk, full reward. So today in NASDAQ, I took full risk, full reward. So I was essentially waiting for that one trade to play out. Something's gone with my NASDAQ candles. My platform is kind of glitching right now. It's a little odd here. Let me refresh. Oh my God. This looks like I glitched my platform here. Whatever. You guys saw in the S&P. I think the market's spazzing out a little bit because the futures market is, the stock market's closed. So the platform is having a fun time glitching a little bit there. There we go. Now we're back. So today in NASDAQ, so at 22,197, which is one of our pivots, it's this one right here. I longed with the intent to get 242. This was roughly 45 or 50 points with a 40-point stop. So about 1.1 to 1 trade. Yeah, sometimes the markets are closed. Our platform tries to spit out a liquidity map when there's no data, and sometimes it hiccups on holidays. It's weird. That was calling my kid Pickle. That's not a bad idea. Any questions? More questions you guys have? Trade I took today was great. My ask what your initial stop once you enter the trade. It's the same. And there's a whole stop philosophy that I have. As a rule of thumb baseline, it's no more than 10, no more than 40 for the most part. If I need to make the stop slightly longer, imagine I have 2 pivots nearby. Say I have 2 lines. Say I had one right here and one right there. And say that the 2 lines are only 20 points apart. I have a rule of thumb that if the 2 lines are within my 40-point stop, then if I normally was going to take a position of 3, if I have 2 entries nearby within my normal stop limit, I'll split my 3 up into 2 positions so that way I can total 3. In case it dips to the second pivot, I can actually play both hands. This is a trading trick for betting correctly, right? So another thing is that what if the second pivot, like the second blue line was like, I don't know, pretend that this is 50 points. Say my normal stop right here is 40-point stop. I need to X the trade at 40. I long and there's 40. But then there's another high volume pivot nearby at 50 points lower. I can now modify my trade plan to go a little bit over my stop, but because I'm going to do that, I need to take initial risk smaller at the start. Say my normal position on this trade was going to be 3, and I saw I had a pivot here and a pivot here. This is like right here as we're falling and go, aha, we might fall to my pivot. Oh, there's 2 nearby and they're 50 points away. That's kind of bigger than my stop. So I'd have to take one and hold bigger than my stop to take the second one. So what I can do is instead of taking 3 contracts at the first one, I can choose to split it up. I'll do 1 at the start and the other 2 much farther away than my actual maximum stop. I'm holding a little bit longer, but what did I do to compensate? See, 3 points at 40, right, is $2,400 of loss on NASDAQ contract. That's how much 40 points of drawdown will give me on 3 contracts. But if I choose to make my smaller position 1, just in case it pivots off of there, I make something. But in case it falls 50 points now, 1 contract on 50 is just 1,000 points of loss. So I actually lowered my risk to allow myself to stop harder. And that's one of the betting philosophies that you have, is that if you're allowing yourself more room to stop to catch a second good entry, then your first position needs to be smaller, so the cash equivalent for the longer travel is less. That makes sense. So in the case I'm teaching you now, is if I had 2 pivots nearby and I wanted to do 3, I'm not going to do 3 and then 3 more. Oh no. I'm going to do 1 and 2, so the total is 3. So that way I'm betting on both hands. If this hand doesn't take off with 1 and falls to there, then I get 2 right here with a cost basis a third of the way up. And then my new stop is based off of my new cost basis. So 40 points below there. I have 2 trades I'm playing. It's like going to a blackjack table and you have a face card down and a jack and a face card down and a jack, and you have the option to play both of them. Play both of them. The odds are really good right on the payout there. So you want to play every blackjack you see. The problem is how far away do you stop? And you have a sliding scale of lowering your position or spreading your position out if the space between them is really far. Now, if my normal stop is 40 and the pivots are 80 points apart, I'm not going to do that and hold 80 points. I give myself, 10 or 20 points of leeway to kind of play with the position to get in the 2 trades. But if I have 2 really strong pivots like 80 points away, I'll stop on the first one and play the second one differently. Yeah. How do I know if my initial entry should be smaller? When you have 2 pivots nearby within the distance of your stop or slightly beyond your stop. So in S&P, if I have 2 strong pivots nearby, like example, and they're within 10 points of each other, I'll trade both of them as part of a bigger trade. A lot of our setups, I'm going to try to catch the liquidity map as it shows. There we go. Cool. A lot of our setups have this particular thing. When the options print out the liquidity map every day, this is actually predicting the flow, and each one of these arrows will predict high volume pivot. It's one of the coolest things we do. And so an example is like this particular setup. This is if you gap up above hedge pressure. I could long at 1A to the next resistance, or it can dip to this blue and I can long again back to the open. So it's a gap and go when we rally, or a gap that fades that pulls back to open. I want to trade both hands. So instead of like throwing my whole position at one spot, I determine the size of my position here. This is the position guidelines at the top, and you'll learn this in the class. Don't try to figure it out now. Say that this S stood for 5, okay? And right when the market gaps up, I look at this, and this is only 5 points away, the distance between here to here. Aha, I have 2 really strong pivots within 5 points of my first entry. If 10 points is my stop, then I should play both hands. And instead of taking my 5 contracts and throwing it at the first one, because I know I have 2 really good strong pivots nearby, I'm going to split up my position like that. The second entry should always be bigger than the first. You're adding when it's slightly red, but you have a really high probability pivot. That blue pivot pivots 80% of the time under ideal conditions. The conditions are ideal, I'll split it up 2 and 3. If the conditions are not ideal, I might lower it even further. 1 and 2. I might not trade the full 5. I might only trade 3. And we teach you the whole scale right here to do that. So if you have 2 entries nearby within your stop range, which is 10 S&P, 40 NASDAQ, then I lower my position on the first one so that I can have buying power to buy the second one. Is this similar to DCA? DCA, okay, this is called cost basis management, CBM. CBM is cost basis management, which is a philosophy to lower or alter your cost basis to lower your risk. Under the umbrella of CBM, DCA is part of a CBM philosophy. Dollar cost averaging is one way to manage a cost basis. Dollar cost averaging just means you're adding to a loser. You're longing and longing and longing and longing that ultimately your overall cost basis is low enough that you're betting on the overall bull market ultimately producing profit. The CBM strategy I'm teaching you is controlled dollar cost averaging. It's not adding to losers though. It's playing 2 winners at once. If your first hand, it's like an example is I have 2 pivots that both pivot at 80%. Well, there's a chance that the 20% happens. So because I know there's a 20% odd, but I have an 80%, and say that I have like 100 points of drop until the next pivot, then I'm going to play and we open up here. Then I'm going to say, aha, 80% bounce there, 80% bounce there. And then if it falls really far. So down in here is where I'm actually going to kill the trade and be done because I'm not going to hold 100 points. But aha, I might want to long here and play this hand. And if it falls, also play this hand. I've doubled down on 2 really good hands because in a DCA strategy, you're adding to a loser. It's a loser here, but it's not a loser here. It's actually a winner that hasn't started yet. It's a winning trade that's waiting to set up as well. It's an 80% winning trade. So in the range, if you have a probability of something happening greater than 50, 60% or higher, then it's actually, you're adding to a winning trade while your account is still red. When you add to an idea where you're in a 20% range with 100 points to fall, that is adding to a losing trade. If you DCA here, it's effective cost basis management. If you DCA here, you're just an idiot and you're gambling with the martingale and you're going to die. You fail. So prop firms promote the narrative that DCA is bad trading or risky. And that's why they do it. As Momentum Delta is saying completely, right? You can't log into the free Discord, get the message, claim and verify your account before you can send messages on this server. So Discord requires you to verify that you're not a bot. So you have to go to Discord and give it your phone number and all that stuff to verify in Discord. So, right? Prop firms tell you don't DCA. And the reason they tell you don't do that is, as Momentum has said, they promote the narrative that DCA is bad trading or risky. But in reality, they don't want you to do any form of cost basis management because it actually works. That's the thing. Now, martingale is an unfair, low-risk way to beat a prop firm by just adding, like, you're not losing money. You're just adding fake money, and ultimately you win. So that's why they say no DCA rule. But every effective trader DCAs appropriately as an effective part of cost-based management. You watch me do it today. You guys remember? Y'all watch me do it today. Before I made my 3,000, didn't I take drawdown? I decided, because the market wasn't open, that I was going to actually long just to kind of plant a contract. And it actually fell. And I was down roughly like $1,000, right? And I planned for myself to lose about 15. I knew this the whole time. And when it fell into my high volume pivot, remember on the stream, I said I'll lose about 15. When it fell to my high volume pivot, I longed 2 more. I had 3 contracts. So I bought, and then I bought again. And then right when it went up to here, I closed out one of the 2 at the 50%. And then I held the other 2 to the gap fill. I made $3,000 with that strategy. I played one random bet that I was just trying to get in on the trade with. Again, we don't have liquidity maps, so I have no entry point here. I just decided to long at the open. If the market were to rally, I would have made $1,000 with one contract. Had the market dipped, I made $1,000 on the way back. But I would have cut the trade right here, maybe. But if you learn in our classes, I would have longed again right here. And this would have been my point of no return. I was actually planning on taking 3 trades. Here and here were both options. And I would have hit this. I hit 1, 2 more. I'd have thrown 3 at it right there. This monthly maps, this orange one has about a 90% same side close rate under all conditions. Only 10% of days will actually break that orange line. Monthly options are very strong at holding the market in place. So Roderick and all these guys, the classes that we teach will walk you through all of these strategies. I can't teach you in this one YouTube. We're about to be done in about 10 minutes, but institutions DCA into their positions every day. Prop firms want you all in and out, which is high probability of losses. Yeah, they want you to overtrade. They want you to isolate all your risk into one trade, prove that that one trade makes money, and that you're not allowed to do effective cost-based management. In the classes we teach, betting correctly is course number 2. It is a course on cost-basis management. I'm never without control. At the start of the day, I said I'll probably lose $1,500 maximum, which was the amount of one contract going to here, longing 2 more, and then going to there. It would have been about $1,500 was my tolerance. If I were to take this one here, I probably would have lost maybe closer to 2,000. But I'm always within control of knowing how much I'm going to lose when I fall to my trade pivots, and that's basically it. And it's all betting. Bootcamp link, yeah, I got you, man. We have a class today. So actually, today's class is at 3:30, and today is the bonus class. This is class number 20, but it's the bonus. It's talking about how to beat trader funding programs. It's all the tricks of the trade. Actually, I can teach you how to DCA when they have a no DCA rule. Like, I have all kind of workarounds for trader funding programs. I got you guys. Y'all come on. Yep, there's the boot camp. Market's closing in 13 minutes. I'm going to go take the day off and chill. I'm watching her play Hogwarts Legacy, and now I'm feeling FOMO. I want to get that game. It looks so cool. Just walking around as in Hogwarts. It's actually pretty fun looking game. I might jump in with them. Is that the link to sign up for the training or the service? So Timmy, that's the boot camp link. If you're interested in the platform itself, which most people end up doing, the platform is it's normally was priced at $200 a month, and we just had this huge revamp where we lowered the price significantly. It's now $99 to try, which includes the boot camp as well. But it's the platform and the tools and the Discord and all that stuff, and the classes are free as part of it. It's $100 for the first month to do that. And then every month after, it's $159. It's just $40 cheaper. But the platform comes with 15 different tools and indicators. They're all volume predicting indicators. And each one of them is part of what we teach. This orange and this blue. We give you the cheat sheets and all the stuff that comes with it. So when you learn, you're going to learn the cheat sheets and like what each one of these things does. This is dynamic futures hedge pressure, or a way to go way of heading calculating morning hedge pressure by using a dynamic open interest estimate model for options. I mean, it's very specific what it is we're doing. You don't have to learn heavy option stuff. You just learn why things happen in position sizing criterias are there. This example says small trade, small trade. I traded small. I wasn't trading really big at those blue lines. The platform, second link's the platform, buddy. You signed for the boot camp. Can you come in the afternoon? Yeah, Michael, today, 3:30, we'll be live on Zoom. What just happened? I don't know. It's a good question. So when you see random news without a high volume pivot, the first thing that you go do is you go check the news. And we teach you this in the pre-market class, how to like go find stuff. So let me pull up my news, wherever it is. Where did you go? Do y'all like the new layout of the stream? I went and did some designs. Do y'all like the gold? I'm still working on it, but it's missing the little marquee at the bottom. Do you like the mat with the glasses at the top? The sunglasses? I think it looks cooler. Can you change the colors of these lines from blue to orange? Yeah, you can. So these you can do in whatever color you want. Where the heck is my pre-market stuff? Oh, here it is. So when something like that happens, I go to Financial Juice and I go look to see if there's any news that came out that I was missing. Nothing is going on right now. Bowman is speaking though, and I think that was on the calendar. We had his Fed speaker today. Yeah, Bowman is speaking this morning, but that was earlier today, I thought. 10:20 Eastern. Yeah, so no, there's no news today. No reason for markets to be doing anything. So in all honesty, European markets already closed. This was nothing. This is just a single sell order. And as you see, the market just went back to where it started. So this was nothing. Somebody's just dumping. There's a couple of reasons for that. Whether A, they're getting out of trade. Like this person was covering a short, right? Jumping in. This person was selling along, jumping out. Whatever the case may be, there's a couple of things. Number one, firms can be buying or selling based on the estimate of tomorrow's open, right? They're getting ahead of possible earnings, getting out of the way of possible earnings. It could be somebody with some inside information that's just dumping their position to get out of the way of something. But in reality, when the market moves a certain direction and moves back, it's not a trend. This is a non-event. So you ignore this now from now on. This didn't mean anything because the market priced it back in. So this was one sell order that the dealers put right back to the liquid spot. They gobbled up. They bought the dip and then they bought back up to here. So it's ignorable. It scared the hell out of you. Yeah, there's no reason for markets to be moving right now, but that is a substantially big order. If I were to take a guess, it's because the futures market halts in 9 minutes and somebody is just taking profit on a big long. I would say that on this dip, somebody probably bought like I did and was holding till the end of the day and probably just decided to take their profit there. 2 points in the S&P is a pretty big enough dump. It was probably, hundreds, if not thousands of contracts, I'm sure. I don't know who's trading and how much, but let's go see. But there's no news event, so there's really no reason for it to fall. And stock market's closed, so it's not like it's tracking any stocks. It was roughly just a 350 contract dump. So it was just somebody dumping some shares. Not a big deal. Illiquid market, stock market's closed. Just somebody took profits. Zoom link gets emailed out, Ron. The Zoom link will actually be in the Discord. There's a channel in our Discord called Zoom Calls. Over here, and in the trading chat area, let's see, this is, so I'll give you guys a little intro. Trading chat is where everybody just kind of chills every day and talks. Really cool group. Zoom Calls is right here. So the training courses are here. There's a little bit of intro work, and then the Zoom call link is posted here every day, and then the boot camps after they're recorded are posted here, and then all your cheat sheets are going to be here that go over each of the things that we teach. So if you're like the $20, you know where it goes to? It goes to the awesome girl that's building this stuff. She takes my scribble scratch that looks absolutely god awful and converts it. It's a pretty looking cheat sheets and edits all the videos for us. She's so nice. She makes everything coherent out of my crappy chicken scratch. She makes these pretty nice. She's really good at putting together these diagrams for us. So, yep, that's pretty much what it is. And what time does the market close today? The futures market doesn't close today. It halts at noon at 12, which is in 7 minutes, noon central. Difference between a halt and a close is that a halt does not count as a close for margining purposes. The market ceases trading, but it's technically still open, but market orders don't get filled. So we're in a halt state. So we pause until 5 p.m. Central. And today is actually Tuesday in the market. So yesterday, last night's trading, and today's trading half day. And then tonight's trading is all part of Tuesday's trading. There's just a halt half day for futures markets being still open when there's a national American bank holiday. So markets halt at noon. But if you're like long a contract and market halts while you're long, you don't get a margin call on a market halt. So it's considered a pause in trading for 5 hours. The ES trade is killing you. End of the day with the EDM I posted this morning. Now we got to do it tomorrow, man. We're running out of time. We'll do it tomorrow. I talked for way too long this morning. All right, guys. But I'm going to end on your song just for fun, for funsies. Let me play his song. So thanks for tuning in, guys. Don't forget to check out our boot camp. Don't forget to check out the... Oh, wait, hold on. The $1 a day class. You'll have a lot of fun in it, I promise. Every day is different. There's a specific thing we talk about, and he posted his... Wait, where is it? Geo. Oh, here it is.
We have a go for main engine start.
Is that the one? Is that the one, Resilience? Or you want to do the other one? This is a theme song submission for the Rock Scooter theme song. Geo, this one or a different one? You have two of them. EDM.
Resilience is key.
Oh. Wrong one. This one. Okay, this one.
The blind monkey trade.
When I sign into Discord, there's no place for Zoom calls. Michael, go to your My Courses, or go to your Rocket Place account.
Trading.
Go to My Communities and then find Discord and click Claim. We'll unlock the channels for the Discord for you.
Monkey.
So when you signed up, you have to actually get access to the Discord. It doesn't automatically just give it to you. And if you still have trouble accessing the Discord, just post in the tech support channel, and the admins will walk you through it, Mike.
A blind monkey can throw darts at a dartboard.
Wait, that's me!
It has a clock on it from 9 all the way until 4. And wherever the dart lands, the monkey longs, the stock longs, the stock longs, the stock longs, the stock longs.
This is great. Yeah, dude, this is not AI, dude. We got Gio's a music producer, man. This is great. He even put some... Oh, wait, y'all gotta see this. Hold up. Bro, dude. What? He's got graphics here. Hold on.
Blind monkey longs, blind monkey longs, blind monkey longs, blind monkey loses a fixed amount, you're done for the day, or you hold it till the end of the day. And if you do that for 20 straight days, and your loss is controlled every day to be smaller, repeat that the next month.
Okay, that's hilarious. Yeah, so the very first class goes over what we call the blind monkey strategy. It's a mathematical thought experiment on position sizing. The blind monkey makes a whole lot of money trading by randomly longing the market and throwing darts at a dartboard. It's an incredible way to start the classes, and what it is designed to do is, well, it does teach you a 100% guaranteed winning strategy. It's not a real strategy you would ever do, but it's the baseline on thought experiment of a strategy that most people do. is that most big firms cost basis manage. They dollar cost average in, and over time, the long just wins. Your 401k runs a similar blind monkey strategy, where they're always throwing money at longs as you're throwing money to them in your paycheck, and they're always long in the market. So blind monkey is like a joke we always throw around because it's how we produce the analogy. But it is it's a winnable trading strategy that in every particular case we ran it wins over time. It's not a real trading strategy, but it does prove that the blind monkey's only control point in his strategy is the size of his position. So on that note, I'm out. It's a really cool, and that is what course 1 is about. Go back to the outro again. Actually, go here. It does. It's really cool how it just shows you that in reality, the winning part of that strategy is not where you buy or what you do or whatever. It's that you long the market and that you control how much you're willing to lose. And if you got those two things down packed, randomly longing the market, you still can make money on paper. And so the proof is that position management is the key to profitability. And that's what the course is actually all about. It's managing your position size, controlling how much you're willing to lose for the account size you have. It doesn't matter what technicals. The blind monkey with the dart is fucking hilarious, dude. I love it. I love the picture. And again, as an engineer, thought experiments are typically what you use for a baseline at creating a real system off of. It's not a real system to randomly long the market. Please don't do that. But mathematically, it proves where your real control and power is in a trading strategy. It's not where you long, it's how you long. Courses today at 3:30. Today is the Trader Funding Program bonus course, and we start over course 1 tomorrow. So come today. If you guys want to come today, come today. We're going to talk Trader Funding Programs. All right, I'm Addy. Love y'all. Thanks for tuning in. Don't forget to subscribe to the